Payment history carries the most weight because lenders want absolute proof that you will consistently pay your bills on time every single month. What is a hard credit inquiry? A hard credit inquiry happens when a lender formally checks your credit report because you applied for a new loan or credit card. Doing this can cause a tiny, temporary dip in your score. What is a soft credit inquiry? A soft inquiry happens when your credit is checked for informational purposes, like when you review your own score or an employer runs a background check, and it does not affect your credit rating at all. How many credit cards should someone have? There is no magic number of credit cards you need, but having just 2 or 3 well-managed cards is usually enough to build strong credit without getting overwhelmed. Hello there. I am so glad you tuned in to hang out with us on the stream today. Is having multiple credit cards beneficial? Having a few cards can definitely help keep your credit utilization nice and low, as long as you pay them off every month. It gives you a bigger pool of available credit, which is super helpful for your score. What is an annual percentage rate? An annual percentage rate represents the yearly cost of borrowing money, which includes your interest rate plus any extra fees. It is super helpful for comparing different loans or credit cards to see which one is actually cheaper. What is an annual fee? An annual fee is a yearly charge that some credit cards require just for having the account open. Usually, Cards with these fees offer extra perks and rewards, so you just want to make sure the benefits are worth the cost. What is a balance transfer? A balance transfer lets you move high-interest debt from one credit card to a new one, usually with a temporary 0% interest rate to help you pay it off faster. What is a cash advance? A cash advance lets you withdraw physical cash using your credit card, but it usually comes with high fees and starts accruing interest immediately. Why are credit card cash advances expensive? Cash advances get pricey because lenders slap on steep upfront transaction fees and immediately start charging a much higher interest rate without any grace period. What is a minimum payment? A minimum payment is the smallest amount of money you can pay on your credit card bill each month to keep your account in good standing. While it helps avoid late fees, paying just the minimum means the rest of your balance will keep accumulating interest. Why should you pay more than the minimum? Tackling more than just the minimum payment saves you a ton of money on interest charges over time. It also helps you crush your debt much faster. How does credit card interest compound? Credit card interest typically compounds on a daily basis by applying your daily periodic rate to your average daily balance. That means the interest you owe gets added right back into your total balance every single day. What is a grace period? A grace period is a window of time between the end of your billing cycle and your payment due date when you won't be charged any interest on new purchases. How can you avoid credit card interest? You can completely avoid paying credit card interest by paying off your statement balance in full every single month before the due date. What is a credit limit? Your credit limit is simply the absolute maximum amount of money the bank will let you borrow on that specific card. Staying well below that threshold is super important for keeping your credit score in great shape. How do banks determine credit limits? Banks figure out your credit limit by looking at your income, existing debts, and overall credit history to see how much risk they are taking on. What is a secured credit card? A secured credit card requires you to put down a cash deposit up front, which usually matches your spending limit, making it a fantastic tool for building your credit history from scratch. What is an unsecured credit card? An unsecured credit card is just a regular card that doesn't need any cash deposit up front. The bank approves you based entirely on your credit history and trust. What is a debit card? A debit card takes money directly out of your checking account for purchases, meaning you are spending funds you actually have rather than borrowing from a bank. What is the difference between credit and debit? Using credit means you are borrowing money from a bank that you have to pay back later, while a debit card uses the actual cash you already have sitting in your checking account. Which is safer for online purchases, credit or debit? Credit cards offer much better fraud protection for online shopping, since you aren't directly dipping into your personal checking account funds. What is overdraft protection? Overdraft protection is a handy bank service that covers your purchases if your checking account balance drops to zero, saving you from embarrassing declined cards and hefty fees. How do bank overdraft fees work? Bank overdraft fees kick in when you spend more money than you actually have in your checking account, and the bank covers the transaction for you. It is definitely a costly surprise, which is why keeping a close eye on your balance helps avoid those extra charges. What is a checking account? A checking account is basically your everyday money hub, where you can easily deposit funds, pay bills, and make purchases using a debit card. What is a savings account? A savings account is a secure place to stash your extra cash, where it can slowly grow over time by earning interest. Why do banks pay interest on deposits? Banks pay interest on your deposits because they use that money to fund loans for other customers, sharing a piece of the profits they make with you. How do banks make money? Banks mainly profit by charging interest on loans they give out and by collecting various account fees, which helps cover their operating costs while still leaving room to grow. What is fractional reserve banking? Fractional reserve banking is a system where banks keep only a small percentage of their total deposits in cash reserves while lending out the rest to generate revenue. It is the foundation of how modern banking works. What is the best way to pay off debt? Tackling what you owe works best by either focusing on the highest interest rates first to save money, or knocking out smaller balances quickly for an extra motivation boost. What is the debt avalanche method? The debt avalanche strategy involves targeting the highest interest rate balance first, while making minimum payments on everything else, which saves you the most money over time. What is the debt snowball method? The debt snowball method is a repayment plan where you knock out your smallest balances first for quick psychological wins, then roll those payments into the next accounts. Which is better, debt avalanche or snowball? Choosing between avalanche and snowball really comes down to your personal style. Avalanche saves you the most money on interest, while snowball gives you those quick wins to keep you motivated. How does the debt avalanche save money? The avalanche approach cuts down on total interest charges by wiping out high-rate debts right away, meaning less money gets wasted on costly finance charges over the long haul. Why does the debt snowball help motivation? The debt snowball method boosts your drive by giving you those quick, early victories as you completely wipe out smaller accounts one by one. Should you invest while paying off debt? Balancing investing while paying down what you owe usually depends on the interest rates involved, especially if your investments could earn a higher return than your loan costs. Should high-interest debt be paid before investing? Generally, it makes sense to clear out high-interest loans first because the guaranteed savings on interest usually beat average investment market returns. What interest rate is considered high for debt? Generally, any interest rate above 8 or 10% is considered pretty high, since it outpaces typical long-term investment returns. How can you negotiate a lower interest rate? You can totally reach out to your credit card company or lender to ask for a reduced rate, especially if you have a solid payment history. Sometimes they will lower it just to keep you as a happy customer. Can credit card companies lower interest rates? Lenders definitely can lower your APR if you ask, especially if you have a great track record of on-time payments. What is debt consolidation? Debt consolidation simply means rolling multiple balances into a single new loan, which can make your monthly payments much easier to manage. What are the advantages of debt consolidation? Combining multiple bills into one single monthly payment can seriously simplify your financial life and might even secure you a lower interest rate overall. What are the risks of debt consolidation? Bundling your balances into a single loan might occasionally stretch out your repayment period, which could end up costing you more in total interest over time. Plus, if you don't address the habits that led to the debt, you might end up running up those credit cards again while still paying off the new loan. What is a debt consolidation loan? A debt consolidation loan is a brand new personal loan you use to pay off several smaller debts all at once, leaving you with just one bill to track each month. What is a personal loan? A personal loan is an amount of money you borrow from a bank or credit union that you pay back in fixed monthly installments over a set period. People often use them for things like home improvements or covering unexpected expenses. What is an installment loan? An installment loan is a specific amount of money you borrow and pay back in scheduled, equal monthly payments until the balance is fully cleared. These typically have a fixed interest rate and a set end date, just like car loans or mortgages. What is revolving credit? Revolving credit is a type of borrowing like a credit card where you can spend up to a certain limit, pay it back, and then borrow again as needed. What is a line of credit? A line of credit acts like a flexible pool of money that a financial institution lets you draw from whenever you need it. and you only pay interest on the amount you actually use. How does a line of credit work? A line of credit gives you access to a set amount of cash that you can borrow from whenever necessary, and you only pay interest on the specific portion you actually draw. What is a home equity line of credit? A home equity line of credit lets you borrow against the value you've built up in your house, giving you a flexible pool of funds to use as needed. What is refinancing? Refinancing involves swapping out your current loan for a brand new one, usually to secure a better interest rate or lower your monthly payments. When does refinancing make sense? Refinancing usually makes the most sense when market interest rates drop significantly, allowing you to secure a cheaper rate and lower your monthly expenses. It can also be a smart move if you want to switch from an adjustable rate mortgage to a predictable fixed rate loan. What are refinancing costs? Refinancing fees usually cover things like application processing, home appraisals, and title searches, typically adding up to a few $1,000s. How does interest rate affect loan payments? Higher interest rates increase your monthly payments because a bigger portion of your payment goes toward borrowing costs rather than paying down the actual balance. Why do longer loans cost more? Extended loan terms usually mean paying more overall because interest accumulates over a much longer duration, even if your monthly bills look smaller. What is amortization? Amortization is the schedule that breaks down your loan payments, showing how much goes toward the principal balance versus the interest over time. What is an amortization schedule? An amortization schedule is simply a table that maps out every single payment on a loan, showing you exactly how much goes toward paying down the principal versus covering the interest. How much interest do you pay on a loan? The amount of interest you pay depends entirely on your agreed percentage rate, the total sum you borrowed, and how long you take to pay it off. What is principal on a loan? The principal is simply the original amount of money you borrowed, and your monthly payments work to chip away at that starting sum over time. What is interest on a loan? Interest is essentially the fee charged by a lender for borrowing their money, calculated as a percentage of the amount you still owe. Why does the early portion of a mortgage have more interest? At the start of a mortgage, you owe the largest possible amount, which means the lender charges interest on that huge initial balance first. What happens when you make extra loan payments? Sending extra cash toward your loan actually goes straight to lowering the principal balance, which cuts down how much interest piles up later. Is it better to pay debt or invest? Choosing between paying off debt and investing usually comes down to comparing your debt's interest rate with the returns you could potentially earn in the market. Many people like to tackle high-interest debt first, because getting rid of it is a guaranteed financial win. What is a debt-free lifestyle? Living debt-free means you don't owe any money to lenders. So every single dollar you earn stays entirely in your own pocket to save or spend however you choose. How can someone become debt-free faster? Paying off liabilities quicker is all about throwing extra funds at that main balance and ditching high-cost loans first. How does debt affect mental stress? Carrying heavy financial burdens can really wear on your mind, often causing constant worry and sleepless nights. Taking steps to manage or reduce what you owe brings incredible peace of mind. Why do people get trapped in minimum payments? Minimum payments mostly cover the interest charges rather than shrinking the actual balance, which causes loans to drag on for years. What is predatory lending? Predatory lending involves unfair or deceptive loan terms that trap borrowers in cycles of high debt. It's really unfortunate, so always check the fine print carefully. What is a payday loan? A payday loan is a small, short-term loan meant to bridge the gap until your next paycheck, but they usually come with extremely high fees and interest rates. Why are payday loans expensive? Payday loans carry massive fees because lenders take on extra risk with short-term advances. Plus, they usually target people who need cash instantly. What is an installment payday loan? An installment payday loan lets you borrow cash and pay it back in multiple scheduled chunks instead of all at once. But those sneaky interest rates can still add up fast. What is a buy now pay later service? A buy now pay later service lets you grab what you want immediately, and split the total cost into smaller, bite-sized installments over a few weeks. Just keep an eye out for any hidden late fees if you happen to miss a payment deadline. Are buy now pay later plans risky? Buy now pay later plans can definitely sneak up on you if you lose track of the smaller payments, which might lead to unexpected fees. It is always smart to read the terms closely before checking out. How does buy now pay later affect credit? Using those deferred payment services can impact your credit score depending on the specific provider and whether you fall behind on installments. Some platforms report missed payments to the major bureaus, which can quietly lower your score over time. What is a consignor? A consignor is a trusted person who agrees to take on the responsibility of your loan if you are unable to make the payments yourself. It is a big favor to ask since it puts their own credit on the line too. What risks does a consignor take? When you cosign for someone, you are legally promising to pay off the entire debt if they miss payments, which can severely damage your own credit score and hurt your ability to borrow in the future. What happens when someone defaults on a loan? Defaulting means someone stopped making their required payments altogether, which leads the lender to take serious action, like sending the account to collections or seizing collateral. What is loan default? Loan default happens when a borrower completely stops making their required payments, giving the lender the right to take legal action or seize collateral. What is delinquency? Delinquency happens the moment you miss a scheduled payment deadline, signaling to the lender that your account is past due. It is basically the warning stage before formal default occurs. What happens after missed payments? When you miss a payment, lenders usually reach out with reminders and might charge a late fee. If the account stays past due for too long, it can eventually be sent to a collection agency, which really hurts your credit score. How long can negative credit information remain? Generally, standard negative marks like late payments can stay on your credit report for up to 7 years. Bankruptcies can linger even longer, sometimes sticking around for a decade. What is bankruptcy? Bankruptcy is a legal process for individuals or businesses who cannot pay their debts, allowing them to either wipe out what they owe or set up a manageable repayment plan. How does bankruptcy affect credit? Filing for bankruptcy causes a major drop in your credit score and leaves a lasting negative mark on your credit history for several years, making future borrowing much harder. What is consumer proposal? A consumer proposal is a legal agreement where you offer to pay a percentage of your debts back or extend your timeline through a licensed professional. How does insolvency work? Insolvency happens when someone simply lacks the financial resources to pay off their debts as they become due. It is a tough situation that often leads people to look into options like bankruptcy or debt restructuring. What is secured debt? Secured debt is tied to collateral, like a car or a home, meaning the lender can take that asset if you stop making your payments. What is unsecured debt? Unsecured debt isn't backed by any physical collateral, so lenders don't have a specific asset they can automatically seize if you fall behind. Why do secured loans usually have lower rates? Secured loans offer better rates because the lender holds collateral, which significantly lowers their financial risk if something goes wrong. What happens when collateral is repossessed? When collateral gets repossessed, the lender takes back the asset you used to secure the loan and sells it to help cover what you still owe. What is a credit report? A credit report is basically a detailed history of how you've handled borrowing money in the past, including your loans and payment habits. How do you check your credit report? You can easily pull your official credit report online through major credit bureau websites, and you usually get free weekly access. What is a credit bureau? A credit bureau is an agency that collects your financial data and payment history to create the reports used to calculate your credit scores. Why should you check your credit report? Reviewing your credit report regularly helps you spot any errors or signs of fraud early on. It is a great way to stay on top of your financial health. What is identity theft? Identity theft happens when someone steals your personal information to pretend to be you, usually to commit fraud or open accounts in your name. It is definitely something you want to watch out for by keeping your details secure. How can financial identity theft happen? Identity thieves usually grab your personal details through data breaches, phishing scams, or even stolen mail to secretly open accounts in your name. Staying vigilant with your personal information is the best way to keep those scammers away. How can you protect your financial accounts? You can protect your accounts by using strong, unique passwords and turning on two-factor authentication wherever possible. It is also super helpful to set up alerts so you get notified of any unusual activity right away. What is two-factor authentication? Two-factor authentication adds an extra layer of security by requiring two different forms of verification before you can log into an account, like a password plus a code sent to your phone. Why should financial accounts use strong passwords? Strong passwords make it much harder for unauthorized people to guess your login details and break into your private profiles. It is a simple step that goes a long way in keeping your personal information safe. What is a bank statement? A bank statement is a summary provided by your bank that shows all the transactions, deposits, and withdrawals on your account over a specific period. It is super helpful for keeping track of your spending and making sure your account balance is accurate. Why should you review bank statements? Going over your statements lets you double-check every transaction so you can catch any weird charges or mistakes right away. It is a fantastic habit for staying totally in control of your cash flow. What is an emergency fund? An emergency fund is money you set aside specifically for unexpected expenses, like sudden medical bills or car repairs. Having that cash cushion really gives you peace of mind when surprises pop up. How many months of expenses should an emergency fund cover? Aiming for 3 to 6 months of living expenses is generally the sweet spot for your safety net. That way, you will be totally covered if any major surprises pop up. Where should an emergency fund be stored? Your safety net cash is best kept in a high-yield savings account, so it stays easily accessible while earning a bit of interest. You definitely want to keep it separate from your regular spending money. Should an emergency fund be invested? It is usually best to keep your safety net cash in liquid accounts rather than investing it in the stock market, since you want it immediately available for sudden crises without any risk of market drops. What is a rainy day fund? A rainy day fund is simply a dedicated stash of money set aside to cover minor unexpected costs, like a sudden appliance repair or a parking ticket. It is a fantastic way to handle life's little hiccups without stressing out your everyday wallet. How is a rainy day fund different from an emergency fund? A rainy day fund is meant for smaller, minor surprises like a broken appliance, while an emergency fund is a larger safety net for major life events like losing a job. What expenses qualify as emergencies? True emergencies are major, unexpected events that you really cannot avoid, like urgent medical care, sudden job loss, or essential home repairs. They are meant for true financial crises rather than everyday shopping or planned purchases. Should you use an emergency fund to pay debt? Using your safety net to clear out what you owe is generally not advised unless you are facing extreme hardship. It is usually much wiser to keep that cash intact for sudden life crises and tackle your balances through a dedicated monthly repayment plan instead. How quickly can someone build an emergency fund? Putting together a robust cash cushion takes time, usually requiring a steady routine of tucking away a small portion from every paycheck. Consistency really is the secret sauce here. What is automatic saving? Automatic saving is a handy feature where your bank moves a set amount from your paycheck straight into your savings without you having to lift a finger. Why is automatic saving effective? Automating your savings removes the temptation to spend that cash because the transfer happens behind the scenes before you even notice it. It is a fantastic way to build up your nest egg effortlessly over time. How can payroll deductions help you save? Payroll deductions automatically divert a chunk of your income. What is a savings rate? Your savings rate is simply the percentage of your take-home pay that you manage to tuck away rather than spend. It is a fantastic metric for seeing how fast your personal wealth is growing over time. How do you calculate savings rate? You can figure out your savings rate by dividing the total amount of money you tuck away each month by your overall take-home pay, then multiplying that result by 100 to get a percentage. What is a high savings rate? A high savings rate generally means stashing away 20% or more of your take-home pay each month. It is an awesome target if you want to accelerate your wealth building. Can someone save 50% of their income? Saving half of your earnings is definitely doable, though it takes some serious lifestyle tweaks and careful planning. People who pull this off usually live way below their means to free up that extra cash. What is the FIRE movement? The FIRE movement stands for financial independence, retire early, and it is all about living frugally and investing aggressively to stop working decades ahead of schedule. What does FIRE stand for? FIRE stands for financial independence, retire early. It is all about living below your means and investing intensely to leave the workforce way ahead of the usual timeline. What is lean FIRE? Lean FIRE is a minimalist approach to early retirement where you plan to live on a very strict, modest budget once you leave the workforce. It means you need a smaller nest egg overall because your annual expenses will be quite low. What is fat FIRE? Fat FIRE is a cozy early retirement strategy where you aim to maintain a lavish lifestyle without cutting back on luxury purchases, which simply means you need to stack up a much larger investment portfolio first. What is Coast FIRE? Coast FIRE is a neat strategy where you front-load your retirement savings early in life. letting compound growth do the heavy lifting, so you only need to cover your current living expenses later on. What is Barista Fire? Barista Fire is a clever lifestyle shift where you leave your demanding full-time career to work a lower-stress, part-time job that covers your daily bills while your main investment portfolio continues growing in the background. How much does someone need for Fire? The standard rule of thumb for early retirement is having about 25 times your expected annual living expenses saved up in investments. This is based on the 4% safe withdrawal rate, which helps ensure your portfolio lasts throughout your retirement years. What is the 4% retirement rule? The 4% guideline suggests you can safely withdraw 4% of your total nest egg during your first year of retirement, and then adjust that dollar amount for inflation each year after. It is designed to help your savings last for at least 30 years. Is the 4% rule still reliable? Financial experts still consider the 4% guideline a useful baseline, though many suggest being a bit more flexible with your withdrawals depending on market conditions. What is sequence of returns risk? Sequence of returns risk is the danger of facing a market downturn right when you retire and start withdrawing money, which can drain your savings much faster than expected. What is longevity risk? Longevity risk is basically the worry that you might outlive your retirement savings because you end up living much longer than expected. It is a big reason why planning carefully and building a solid nest egg is so important. What is inflation risk? Inflation risk is the danger that the rising cost of everyday goods will decrease the purchasing power of your money over time. It means your cash won't buy as much in the future as it does right now. What is financial risk? Financial risk is simply the chance that you might lose money or not get the returns you expected on an investment. It is a super important factor to think about whenever you are putting your cash into different markets. What is a stock? A stock represents a tiny fractional ownership share in a publicly traded corporation. When you buy shares, you actually become a part owner of that business. What does owning a stock mean? Purchasing shares of a company means you are buying a tiny slice of that business and sharing in its future success. Why do companies issue shares? Businesses issue shares primarily to raise capital so they can fund new projects, expand operations, or pay off existing debts. It is a really popular way for companies to grow without taking on massive bank loans. What is a shareholder? A shareholder is simply anyone who owns at least one share of stock in a company, making them a partial owner of that business. What is common stock? Common stock is a specific type of equity that gives you a fractional stake in a corporation, along with voting rights at shareholder meetings. It is the most popular way for everyday folks to invest in the stock market. What is preferred stock? Preferred stock is a special class of ownership that usually gives you fixed dividend payments before any go to common shareholders. It is a neat middle ground between regular stocks and bonds. What is a stock exchange? A stock exchange is essentially an organized marketplace where buyers and sellers come together to trade shares of publicly held companies. Think of it like a massive digital auction house that keeps everything transparent and orderly. How does a stock exchange work? stock exchange operates like a giant regulated marketplace where buyers and sellers meet to trade shares easily. It uses electronic matching systems to ensure trades happen fairly and quickly for everyone involved. What is the stock market? The stock market is a centralized hub where investors buy and sell shares of various publicly traded companies. It plays a huge role in helping businesses secure funding while giving everyday people a chance to build wealth. Why do stock prices change? Stock prices bounce around constantly based on supply and demand, which is driven by company earnings, economic news, and overall investor sentiment. What causes a stock to rise? Equities generally climb when a company crushes its earnings reports, launches exciting new products, or benefits from a booming economy. What causes a stock to fall? Stocks typically drop when a company reports disappointing earnings, broader economic conditions turn sour, or overall investor confidence takes a hit. What is market capitalization? Market capitalization is simply the total dollar value of all a company's outstanding shares combined. It is calculated by multiplying the current share price by the total number of shares available, which helps us see how large a company actually is. How is market capitalization calculated? Market cap is figured out by taking the current price of a single share and multiplying it by the total number of shares the company has issued. What is a large cap stock? Large cap stocks belong to massive, well-established corporations that usually have a total market value exceeding $10 billion. They tend to offer steady growth and reliable stability for portfolios. What is a mid-cap stock? Mid-cap stocks refer to medium-sized companies whose total market value generally sits between $2 billion and $10 billion. They offer a sweet spot of growth potential while still providing more stability than smaller startup firms. What is a small cap stock? Small cap stocks are shares in smaller companies with a market value typically under $2 billion, offering higher growth potential alongside a bit more risk. What is a microcap stock? Microcap stocks are shares of very small companies with a total market value usually under $300 million, meaning they can grow rapidly, but also come with much higher volatility. What is a megacap company? Megacap companies are the absolute giants of the corporate world, boasting jaw-dropping market values that usually soar past $200 billion. Think of massive household names that have incredible global influence and immense financial strength. What is a blue chip stock? Blue chip stocks are shares in nationally recognized, well-established, and financially sound companies that have a history of reliable performance. They are usually industry leaders that weather economic downturns quite well. What is a growth stock? A growth stock is a share in a company that is expected to grow at an above-average rate compared to other businesses in the market. These companies usually reinvest their earnings into expansion rather than paying out large dividends, which is super exciting for long-term potential. What is a value stock? A value stock is an equity share that trades at a lower price relative to its fundamental financial measures, like earnings or book value. Investors love them because they often represent a bargain compared to their true worth. What is a defensive stock? A defensive stock is an equity that tends to hold its ground and provide steady returns even when the broader economy is struggling. These companies sell essential goods like groceries or utilities that people need no matter what. What is a cyclical stock? A cyclical stock is a company whose performance tends to rise and fall right along with the general health of the economy. These businesses often sell discretionary items like cars or travel, which people buy more of during good economic times. What is a speculative stock? A A speculative stock belongs to a company with highly uncertain financial prospects, yet it offers the chance of huge returns if the business takes off. These tend to be much riskier, so investors watch them very closely. What is a penny stock? Penny stocks represent shares of tiny companies that trade for very low prices per share, usually under $5. They are often traded over the counter and can be super unpredictable, so people treat them with a lot of caution. Why are penny stocks risky? Penny stocks can be really risky because they trade infrequently, making it hard to sell them quickly without losing money. Plus, the companies behind them often lack detailed financial reporting. What is a dividend stock? A dividend stock is a share in an established company that regularly shares a portion of its profits directly with investors as cash payments. People really enjoy them because they provide a steady stream of passive income alongside potential share price growth. What is a momentum stock? A momentum stock is an equity that rides strong recent price trends, meaning it tends to keep climbing simply because it has already been going up rapidly. Investors love jumping on these to catch the wave of high market excitement. What is a quality stock? A quality stock belongs to a financially robust business with consistent earnings, strong leadership, and a solid competitive edge. These reliable companies usually navigate market ups and downs much better than others. What is a turnaround stock? A turnaround stock is an equity belonging to a company that has hit rough times but is working hard to fix its business model and recover its former glory. If the recovery plan succeeds, investors can sometimes see massive gains. What is a meme stock? A meme stock is a company whose shares skyrocket purely because of viral internet hype and social media buzz, rather than its actual business performance. It can be super wild to watch. Why do meme stocks become popular? Meme stocks usually catch fire because internet communities rally together on social media to drive up the share price, regardless of what the company's financials look like. It creates a massive wave of excitement that pulls in tons of curious traders. What is short interest? Short interest tells us the total percentage of a company's shares that have been shorted by traders betting the price will drop. High short interest can sometimes spark a massive squeeze if the price starts climbing instead. What is a short squeeze? A short squeeze happens when a heavily shorted stock suddenly jumps in price, forcing betting traders to urgently buy back shares just to limit their losses. What causes a short squeeze? A short squeeze gets triggered when a heavily shorted stock suddenly starts rising in value, which forces short sellers to rush in and buy shares to cover their positions and stop further losses. What is a gamma squeeze? A gamma squeeze happens when massive options trading forces market makers to aggressively buy the underlying stock just to stay balanced, driving the price up even faster. How does short selling work? Short selling is when someone borrows shares to sell them immediately, hoping to buy them back later at a lower price to return and pocket the difference. Why do investors short stocks? Traders borrow and sell shares with the goal of buying them back later at a cheaper price to pocket the difference if the company's value drops. What is the maximum loss on a short position? When you short a stock, your potential loss is technically unlimited because a company's share price can keep rising indefinitely. That is what makes short selling extra risky compared to just buying regular shares. What is a stock split? A stock split is when a company decides to divide its existing shares into multiple new ones to make them more affordable for everyday buyers, though the overall value of your investment stays exactly the same. Why do companies split their stock? businesses usually divide their shares to lower the price per individual share, making it much easier for everyday retail investors to buy in. Even though the share count increases, the total value of the company and your holdings remains completely unchanged. What is a reverse stock split? A reverse stock split is when a company merges its existing shares together to decrease the total count, which bumps up the price of each individual share. Why would a company perform a reverse split? Companies typically consolidate their shares to lift the price per share, so it stays above exchange minimum requirements and looks more stable to institutional investors. What is a stock buyback? A stock buyback occurs when a corporation purchases its own shares back from the open market, which reduces the overall supply available and usually boosts the value of the remaining shares. Why do companies buy back shares? Companies repurchase their own shares to decrease the total supply in the market, which can help increase the value of the remaining shares for their investors. How can buybacks increase earnings per share? When a company buys back its own shares, there are fewer shares left floating out there in the market. Since the net income gets divided by a smaller share count, the earnings per share automatically go up. What is dilution? Dilution happens when a company issues new shares, which increases the total supply and reduces each existing shareholder's ownership percentage. How does issuing shares dilute investors? Issuing new shares increases the total count of available stock, which means each current owner ends up holding a slightly smaller slice of the overall company pie. What is earnings per share? Earnings per share is a helpful metric that tells you how much profit a company makes for each individual share of its stock. How is EPS calculated? Earnings per share is figured out by taking the company's net profit and dividing it by the total number of common shares currently available. Why is EPS important? EPS is super important because it acts as a reliable gauge of a company's profitability on a per-share basis. Investors love looking at it to figure out how much money is really being generated for every single piece of the company they own. What is revenue? Revenue is basically the total amount of money a business earns from selling its products or services before deducting any expenses. It's often called the top line because it What is gross profit? Gross profit is the money a business has left over after subtracting the direct costs of making its products. It is a great way to see how efficiently a company produces its goods. What is operating profit? Operating profit is the money a company makes from its core business operations after taking care of regular operating expenses like wages and rent, but before taxes and interest. What is net income? Net income is the total profit a company keeps after paying all its expenses, taxes, and costs, which is why it's often called the bottom line. What is free cash flow? Free cash flow is the cash a company has left over after paying all its operating expenses and capital expenditures. It shows how much actual money the business generates for expansion or paying dividends. Why is free cash flow important? Free cash flow is so valuable because it shows the actual cash a business has on hand to pay dividends, tackle debt, or fund new projects after handling all its bills. What is operating cash flow? Operating cash flow tracks the actual cash generated specifically from a company's normal day-to-day business activities. It gives us a clear look at whether the main operations are bringing in healthy money. What is a balance sheet? A balance sheet is a financial snapshot that outlines a company's assets, liabilities, and shareholders' equity at a specific point in time. It basically shows you what the business owns versus what it owes. What is an income statement? An income statement is a financial report that highlights a company's revenues and expenses over a specific period. It shows you whether the business is actually turning a profit or taking a loss during that time. What is a cash flow statement? A cash flow statement is a handy financial document that breaks down how cash moves in and out of a business through operations, investments, and financing over a specific time frame. Why are financial statements important? Financial statements are super important because they give us a clear picture of a company's financial health and performance. They help investors and business leaders make smart decisions by showing exactly where money is coming in and going out. What is shareholder equity? Shareholder equity is basically the net worth of a company, calculated by subtracting all its liabilities from its total assets. It represents the portion that would technically belong to the owners if all debts were paid off. What are company assets? Company assets are valuable resources owned by a business, like cash, inventory, equipment, and buildings, which help it run and grow. What are company liabilities? Liabilities are essentially the debts and financial obligations a business owes to outside parties, like loans or accounts payable. What is book value? Book value is simply the net asset value of a company calculated by taking its total assets and subtracting all its liabilities. It tells you what the business would theoretically be worth on paper if it shut down today. What is tangible book value? Tangible book value is basically a company's net worth minus any intangible assets like patents or goodwill. It shows you the hard physical value left over for shareholders if everything tangible was liquidated. What is goodwill? Goodwill is an intangible asset that pops up on the balance sheet when one company buys another for a price higher than the net value of its identifiable assets. It basically represents things like brand reputation, customer loyalty, and intellectual property. What is depreciation? Depreciation is an accounting method used to spread out the cost of a physical asset over its useful lifespan. It helps businesses reflect how equipment or machinery loses value gradually as it gets older and is used more. What is amortization? Amortization is very similar to depreciation, but it applies to intangible assets like patents or copyrights instead of physical items, spreading their cost over time. What is EBITDA? EBITDA stands for earnings before interest, taxes, depreciation, and amortization, which is a great metric to look at a company's pure operating profitability. It strips away those non-operating expenses so you can really focus on how well the core business is performing. What does EBITDA measure? EBITDA gives us a clear look at a company's operational earnings by by ignoring financing choices, tax codes, and non-cash write-offs. It is super handy for comparing the core profitability of businesses in the same industry side by side. What is EBIT? EBIT stands for earnings before interest and taxes, which measures a company's profit by excluding those specific expenses. It is super helpful for seeing how much money the core operations bring in without outside financial factors getting in the way. What is gross margin? Gross margin is the money a company keeps after paying off the direct costs of making its products. It is usually shown as a percentage to help us see how efficiently the main production is running. What is operating margin? Operating margin reveals the percentage of revenue left over after paying for variable costs like wages and raw materials, showing how much profit a company makes on each dollar of sales. What is net margin? Net margin shows you the final percentage of revenue that turns into actual net profit after covering all business expenses. Why are profit margins important? Profit margins are super important because they show us how effectively a business is turning its sales into actual financial gain. They let us easily spot which companies are running smoothly and keeping their costs under control. What is return on equity? Return on equity measures how effectively a company uses its shareholders' investments to generate profit. It is basically calculated by dividing net income by total shareholders' equity. What is return on assets? Return on assets is a fantastic metric that shows how efficiently a company uses its total property and equipment to generate a profit. It is calculated simply by dividing net income by total assets. What is return on invested capital? Return on invested capital looks at how well a business allocates its money to profitable ventures by comparing net operating profit to total debt and equity. It is a handy way to see if a company is actually creating value with the funds it raises. Why is ROIC important? ROIC is super helpful because it tells us if a company is actually making smart choices with the money it raises from lenders and shareholders. It cuts through the noise to show us who is truly building value. What is the price-to-earnings ratio? The price-to-earnings ratio helps us figure out if a company's stock price is valued fairly by comparing it to its per-share earnings. It is a neat tool for checking whether a stock might be a bargain or overly expensive. How is PE calculated? The price-to-earnings ratio is figured out simply by taking a company's current share price and dividing it by its earnings per share over the past year. It is a classic way to see what investors are willing to pay for every dollar of profit the company brings in. What does a high PE mean? A high price-to-earnings ratio typically means investors expect the company's profits to grow significantly in the future. It can also suggest that the stock is priced quite high relative to its current earnings. What does a low PE mean? A low price-to-earnings ratio often points to a stock that might be undervalued or trading at a discount compared to its peers. Sometimes it can also signal that the business is facing temporary challenges or that investors do not anticipate much future growth. What is forward PE? Forward PE takes that same valuation idea, but swaps past earnings for the company's estimated future earnings. It gives us a quick glimpse into what investors anticipate the business will earn in the upcoming year. What is trailing PE? Trailing PE looks backward at a company's actual earnings from the past 12 months to evaluate its current share price. It grounds our valuation in real historical performance rather than future guesses. What is the PEG ratio? The PEG ratio takes the standard price-to-earnings metric and adjusts it for the company's expected earnings growth rate. It is a handy way to see if a stock's valuation is actually justified by how fast the business is expanding. What is price to sales? The price-to-sales ratio compares a company's total market value to its yearly revenue. It is particularly useful for valuing startups or businesses that are not yet turning a profit. What is price to book? The price-to-book ratio compares a company's stock price to its net asset value per share. It is a neat way to see if you are paying a fair price for the actual physical assets backing the business. What is enterprise value? Enterprise value looks at the total price tag of a business by taking its market capitalization, adding total debt, and subtracting any cash on hand. It gives us a much clearer picture of what the entire company would actually cost to acquire. What is EV to EBITDA? The EV to EBITDA ratio compares a company's total enterprise value to its earnings before interest, taxes, depreciation, and amortization. It helps us evaluate a business's valuation while leveling the playing field across different capital structures and tax environments. What is a valuation multiple? A valuation multiple is a financial metric that compares a company's market price to a specific operational or financial figure, like its earnings or sales. How do investors value a company? Investors figure out a company's worth by looking at various financial metrics like earnings, revenue, and overall assets to see what it is really worth in the market. What is discounted cash flow analysis? Discounted cash flow analysis is a method used to estimate the value of an investment by predicting its future cash flows and adjusting them back to today's value. What is intrinsic value? Intrinsic value is our best estimate of what a company is actually worth based on its future cash flows, rather than just its current market price. What is a margin of safety? A margin of safety is the cushion between an investment's estimated true value and its current market price, helping protect us from potential losses if things don't go as planned. Why can a cheap stock stay cheap? An inexpensive stock can sometimes stay that way if the company has fundamental underlying problems or lacks growth catalysts to spark investor interest. That is why it is so important to look beyond just the low price tag and check the business fundamentals. Can a great company be a bad investment? Even a wonderful business can turn into a poor investment if you pay far too much for its shares initially. Valuation and purchase price truly matter just as much as the quality of the underlying company. What is investing? Investing is the act of putting your money into assets like stocks or funds with the goal of growing your wealth over time, as those investments hopefully increase in value. What is passive investing? Passive investing is a strategy where you buy and hold a fund that tracks a broad market index, like the S&P 500, rather than constantly trading individual stocks. It is a wonderful, low-stress way to build long-term wealth with lower fees. What is active investing? Active investing involves frequently buying and selling assets, like individual stocks, with the goal of beating the overall market returns rather than just matching them. Which is better, active or passive investing? Passive investing usually wins for most people because it keeps fees low and takes away the stress of trying to time the market. Active investing can be super exciting, but it is really tough to consistently beat those overall market returns. What is buy and hold investing? Buy and hold investing is a strategy where you purchase assets and keep them for a long time, ignoring short-term market ups and downs. It is a fantastic way to let your investments grow steadily with very little maintenance. What is long-term investing? Long-term investing is all about holding onto your assets for years or even decades to let compounding work its magic. It is a super patient approach that helps you ride out short-term market bumps while growing your wealth over time. Why is time in the market important? Time in the market matters because letting your investments stay put allows compound growth to really work its magic over the years. Plus, it gives your portfolio a better chance to recover smoothly from any short-term market dips. What does timing the market mean? Timing the market is trying to guess the exact moments to buy low and sell high, but it is practically impossible to do consistently. That is why staying steadily invested is usually a much smoother ride. Can investors consistently time the market? Trying to accurately time the market is practically impossible to pull off consistently because nobody can truly predict those sudden price swings. Sticking to a steady plan usually saves you a lot of unnecessary stress. What is dollar cost averaging? Dollar cost averaging is when you invest a set amount of money regularly, no matter what the market is doing, which helps you buy fewer shares when prices are high and more when they are low. Why does dollar cost averaging work? Dollar cost averaging helps by taking the guesswork out of purchasing, letting you automatically buy more shares when prices dip and fewer when they are high. What is lump sum investing? Lump sum investing means putting all your available money into the market right away instead of waiting, letting your entire balance start working for you immediately. It historically tends to outperform spreading contributions out because your cash is invested longer. Is lump sum investing better than dollar cost averaging? Lump sum investing historically yields better results because your funds spend more time working for you in the market. However, dollar cost averaging can feel much more comfortable if you prefer avoiding the anxiety of a sudden market downturn right after putting your money in. What is diversification? Diversification is just a fancy way of saying, don't put all your eggs in one basket. Spreading your money across different types of investments helps protect you if one particular company has a rough patch. Why is diversification important? Spreading your funds across different industries helps cushion the blow if one particular sector hits a rough patch. It is all about keeping your overall journey smooth and secure. How many stocks should a portfolio hold? Having around 20 to 30 individual stocks is usually enough to give you a well-rounded portfolio without becoming too overwhelming to track. Can you be too diversified? Yes, you actually can over-diversify if you spread your money across too many overlapping assets, which can dilute your potential gains. Keeping a balanced mix is usually the sweet spot. What is asset allocation? Asset allocation is simply the way you divide your investments among different categories like stocks, bonds, and cash to balance risk and reward. Why does asset allocation matter? Asset allocation matters because balancing your mix of stocks and bonds helps cushion your portfolio against unexpected market drops. It is all about tailoring your strategy to match your personal comfort with risk. What is portfolio rebalancing? Portfolio rebalancing is the process of periodically adjusting your investments back to your original target mix, so you do not take on too much risk. How often should a portfolio be rebalanced? Most folks like to check and tune up their portfolio once or twice a year to keep everything aligned with their goals. It is a great way to stay on track without overthinking every little market wiggle. What is portfolio drift? Portfolio drift happens when your original investment mix slowly changes over time, because certain assets grow faster than others. It is totally normal, which is why checking in on your accounts periodically helps bring everything back to your desired balance. What is risk tolerance? Risk tolerance is simply your personal ability and emotional readiness to handle the ups and downs of the stock market. It helps guide you in choosing investments that keep you feeling comfortable and secure. How do you determine risk tolerance? Figuring out your risk tolerance is all about looking at your financial goals and how you feel when the market dips. Taking a quick online questionnaire or chatting with a professional can also help you pin down the right comfort zone. What is risk capacity? Risk capacity is your actual financial ability to absorb potential investment losses without messing up your essential daily living expenses. It looks closely at your timeline and cash flow rather than just your feelings. What is investment time horizon? An investment time horizon is the total length of time you plan to hold your investments before needing to cash out for a goal like retirement or buying a house. Why does time horizon matter? Your timeline matters because it dictates how much risk you can comfortably take, since you have more time to recover from market dips when your goals are far away. What is volatility? Volatility measures how wildly and quickly the price of an investment swings up and down over a given period. Higher volatility simply means bigger price jumps and drops, which can make your account balance look like a roller coaster. Is volatility the same as risk? They are definitely related, but volatility specifically tracks how fast prices bounce around, whereas risk includes the chance of actually losing your money. What is standard deviation? In investing, standard deviation shows what is beta? Beta measures how much a specific stock's price jumps around compared to the overall market. A beta above 1 means the stock is usually more jumpy than the market, while a lower number means it is steadier. What does beta measure? Beta measures how drastically a single stock's price moves relative to the broader market fluctuations. A higher figure means the stock tends to swing more intensely than the overall market itself. What is alpha? Alpha is a metric used to describe an investment's ability to beat the broader market benchmark. If a portfolio manager achieves a positive alpha, it means they generated excess returns through smart stock picking. What does investment alpha mean? Investment alpha is a metric used to see how much an active manager's picks outperformed a baseline market index. A positive number means the strategy beat the benchmark, while a negative one shows it lagged behind. What is Sharpe ratio? The Sharpe ratio helps investors figure out if an investment's returns are worth the amount of volatility taken on to get them. It essentially compares the excess return of a portfolio against its risk. What does the Sharpe ratio measure? The Sharpe ratio figures out if the returns you are getting are genuinely worth the price swings you had to endure. It essentially weighs your extra gains against the total turbulence of the portfolio. What is downside risk? Downside risk is the chance that an investment will drop in value or perform worse than you expected. It specifically looks at the potential for negative outcomes so you can prepare for potential losses. What is drawdown? A drawdown measures the peak-to-trough drop in an investment's value before it recovers. It really shows you the absolute worst-case loss you would have experienced during a specific period. What is maximum drawdown? maximum drawdown is the largest observed drop from a portfolio's peak value to its lowest point before a new peak is reached. It gives us a really clear picture of the worst historical loss an investor could have endured. Why does drawdown matter? Tracking the biggest peak-to-trough drop helps you understand the worst-case scenario your portfolio might face. It gives you a realistic idea of the turbulence you could experience during a rough market patch. What is a bear market? A bear market happens when stock indexes fall by 20% or more from recent highs due to widespread pessimism and economic slowdowns. It can feel a bit gloomy, but remember that market downturns are completely normal parts of the economic cycle. What is a bull market? A bull market is a prolonged period where stock prices are generally rising and investor confidence is running high. It is basically the opposite of a bear market, filled with lots of optimism. What defines a market correction? A market correction happens when an index drops by 10% or more from its recent high. It is totally normal and usually helps cool off an overheated market. What is a market crash? A market crash is a sudden, dramatic drop in stock prices across the board, usually triggered by panic selling or major economic shocks. It can definitely be scary to watch unfold, but markets have historically always bounced back given enough time. What causes market crashes? Market crashes are usually sparked by sudden panic selling, unexpected economic shocks, or bursting financial bubbles. When everyone rushes to exit their positions at the exact same time, prices tend to plummet dramatically in a very short window. Why do markets recover after crashes? When stock prices plunge, valuable companies become huge bargains. How long do bear markets usually last? Bear markets can vary quite a bit, but but historically they tend to last anywhere from several months to a little over a year on average. Every cycle is different though, and they are just a normal part of how the financial markets move over time. How long do bull markets usually last? Bull markets can stick around for quite a while, often lasting several years on average. They are driven by strong economic growth and happy investors riding that positive momentum. What is a market cycle? A market cycle describes the repeating patterns of expansion and contraction that economies and investments go through over time. It basically covers the full journey from economic growth all the way through downturns and back up again. What are the stages of a market cycle? A market cycle generally moves through 4 distinct phases: expansion, peak, contraction, and trough. Each stage represents a different part of the economic journey from growth all the way down to a downturn and back up again. What is investor sentiment? Investor sentiment is basically the overall mood or attitude of people in the market towards stocks. When everyone feels super optimistic, prices usually go up, but fear can quickly send things sliding downward. How does fear affect markets? When widespread fear takes over, people tend to panic and sell off their investments quickly, which drives overall prices down. How does greed affect markets? Greed often pushes stock prices way higher than they are actually worth, creating dangerous financial bubbles. When everyone gets too confident, it usually leads to a sharp and painful drop once reality sets in. What is herd behavior? Herd behavior happens when people blindly copy what everyone else is doing in the market, instead of doing their own research. It usually leads to massive buying or selling frenzies based purely on emotion. What is FOMO in investing? FOMO stands for the fear of missing out, which happens when investors jump into a soaring stock just because everyone else is doing it. It often leads people to buy at the worst possible time right before a price correction. How does FOMO affect investors? FOMO pushes people to jump into popular investments impulsively, often causing them to buy right before the market shifts. What is panic selling? Panic selling happens when investors suddenly get scared and unload their shares all at once to avoid losing more money. It usually causes prices to drop even faster across the board. Why do investors sell during crashes? During a market crash, investors often sell in a rush to cut their losses and protect whatever cash they have left. It is totally natural to feel stressed when portfolio values drop so fast. What is contrarian investing? Contrarian investing is a strategy where you buy assets that are currently out of favor and sell the ones everyone else is rushing to buy. It takes a lot of patience to go against the crowd, but it can really pay off. What is value investing? Value investing is all about hunting for stocks that are trading way below what they are actually worth. It is kind of like shopping at a clearance sale to find hidden gems. What is growth investing? Growth investing focuses on buying shares in companies that are expected to expand at an above-average pace compared to the rest of the market. People who choose this style usually look for fast-moving tech startups or emerging industries with huge potential. What is quality investing? Quality investing is a strategy where you focus on buying shares of stable, well-established companies with strong balance sheets and reliable earnings. It is all about picking businesses that have a proven track record of weathering economic storms successfully. What is factor investing? Factor investing is a strategy where you target specific drivers of returns, like value or momentum, to build your portfolio. It lets you home in on particular traits that have historically outperformed the broader market. What is momentum investing? Momentum investing is a strategy where you purchase assets that have been showing strong upward price trends recently. The main idea is that securities performing well will likely keep going up for a little while longer. What is dividend investing? Dividend investing is a strategy where you buy shares in companies that regularly share a portion of their profits with shareholders. It is a fantastic way to generate a steady stream of passive income while you build your portfolio. What is income investing? Income investing is all about building a portfolio designed to generate regular cash payouts, usually through bonds or high-yielding assets. It is a wonderful approach if you are looking to create consistent cash flow to help cover your everyday expenses. What is socially responsible investing? Socially responsible investing means putting your money into companies that actively try to make the world a better place through good environmental and social practices. It is a lovely way to align your portfolio with your personal values. What is ESG investing? ESG investing stands for environmental, social, and governance investing, where you choose companies that care about the planet, treat people fairly, and have great leadership. It is a wonderful way to support businesses that match your personal ethics. What is thematic investing? Thematic investing is all about putting your funds into rising trends and big picture ideas, like artificial intelligence or clean energy, rather than focusing on just one company or sector. It is an exciting way to back the industries shaping our future. What is sector rotation? Sector rotation is an investing strategy where people move their money from one industry group to another depending on the current phase of the economic cycle. It is a neat way to capture gains by anticipating which sectors will thrive during booms or recessions. What is defensive investing? Defensive investing is all about picking assets from stable industries, like utilities or consumer staples, that tend to hold their ground during market downturns. It is a wonderful way to protect your hard-earned money when the broader economy gets a little bumpy. What is a core portfolio? A core portfolio is the foundational chunk of your investments made up of steady, reliable assets like broad market index funds. It serves as your financial anchor while you build out other holdings around it. What is a satellite portfolio? A satellite portfolio refers to the smaller group of specialized investments you add around your main core holdings to chase a bit of extra growth. It is a fun way to experiment with riskier assets without putting your foundational wealth on the line. What is a three-fund portfolio? A three-fund portfolio is a super simple investment strategy using just three broad mutual funds to cover the entire stock and bond market. It is a fantastic way to keep things balanced without all the extra hassle. What is a 60-40 portfolio? A 60-40 portfolio is a classic investment mix that puts 60% of your money into stocks for growth and 40% into bonds for stability. It is a time-tested way to balance risk while still capturing decent returns over the long run. Why is the 60-40 portfolio popular? The 60-40 portfolio remains a favorite because it strikes a really nice balance between growing your wealth and protecting it. By dividing funds between equities and fixed income assets, it helps smooth out the bumpy rides in the market while still capturing solid long-term gains. What are alternative investments? Alternative investments are non-traditional assets like real estate, commodities, or private equity that move differently than standard stocks and bonds. They are a cool way to diversify your portfolio beyond the usual market options. What are private investments? Private investments involve putting money into privately held companies or assets that are not traded on public stock exchanges. They are typically reserved for institutional or accredited investors seeking unique growth avenues outside the public markets. What is venture capital? Venture capital is a type of funding where investors provide financial backing to startup companies and early-stage businesses with high growth potential. It is a thrilling way to support fresh innovation, though it definitely comes with higher risks. What is private equity? Private equity involves pooling money to buy stakes in private companies or even acquire entire businesses to help them grow and boost their value. It is a fascinating space that usually operates away from the public stock exchanges. What is angel investing? Angel investing is when an affluent individual provides capital to a startup in exchange for convertible debt or ownership equity. It is a wonderful way for early-stage entrepreneurs to get their businesses off the ground. What is crowdfunding? Crowdfunding is a way to raise money for a project or business by getting small amounts of cash from a large group of people online. It is a fantastic tool for creators to bring their ideas to life with the support of their community. What is real asset investing? Real asset investing means putting your money into tangible physical property like real estate, infrastructure, or natural resources that you can actually touch and see. These physical holdings can offer great protection against inflation because their value often rises right along with the cost of living. What is inflation protection? Inflation protection refers to strategies or assets designed to preserve your purchasing power when the cost of living rises. Owning physical commodities or specific types of bonds can help shield your hard-earned money from losing its value over time. Which assets tend to perform well during inflation? Assets like real estate, commodities, and treasury inflation-protected securities usually hold their ground nicely when inflation heats up. Which assets tend to perform poorly during inflation? Cash and traditional fixed-rate bonds generally struggle during periods of high inflation because their fixed returns lose purchasing power as the cost of living climbs. What is deflation? Deflation is basically the opposite of inflation, happening when the overall prices of goods and services drop across the board. While cheaper stuff sounds great at first, it can actually slow down the economy if people keep waiting for prices to fall even lower. How does deflation affect investments? When deflation happens, fixed income investments can actually look pretty attractive because their purchasing power goes up as general prices fall. On the flip side, businesses might struggle with shrinking profit margins, which can put downward pressure on stock prices. What is stagflation? Stagflation happens when economic growth slows down while prices and unemployment stay stubbornly high at the same time. is a really tricky economic puzzle because traditional fixes usually only target one problem without helping the other. Why is stagflation difficult for investors? Stagflation is tough because stagnant growth hurts corporate earnings while rising prices eat away at returns, leaving investors with very few safe havens. It is definitely a tricky cycle to navigate. What is recession risk? Recession risk is the likelihood that the overall economy will shrink significantly, leading to job losses and a drop in business activity. It is something economists watch closely by tracking indicators like consumer spending and employment rates. What is economic expansion? Economic expansion is a phase of the business cycle where overall production, employment, and business activity steadily increase. It is basically the growth period when the economy is thriving and moving upward. What is a soft landing? A soft landing is a neat economic scenario where the central bank successfully cools down high inflation by raising interest rates without triggering a full-blown recession. It is basically hitting the brakes gently so the economy slows down safely rather than crashing hard. What is a hard landing? A hard landing occurs when a central bank raises interest rates so aggressively to fight inflation that it accidentally pushes the entire economy straight into a severe recession. What is a portfolio hedge? A portfolio hedge is basically an investment strategy you use to protect your existing holdings from potential losses. It acts like an insurance policy for your money when markets get a little too unpredictable. What investments can hedge against inflation? Assets like real estate, commodities, and treasury inflation-protected securities are popular choices to help shield your money from rising prices. What is tail risk? Tail risk refers to those rare, extreme market events that lie way out on the bell curve and usually catch people completely off guard. Even though they have a low probability of happening, preparing for them is super important because their impact can be massive. What is black swan risk? Black swan risk refers to those totally unexpected events that catch everyone off guard and leave a massive mark on the markets. Since they are impossible to predict, the best approach is just keeping your overall investment strategy diverse and resilient. Why should investors avoid emotional decisions? Making financial choices based on feelings usually leads to panic selling during market dips or buying out of excitement at the absolute peak. Sticking to a well-thought-out plan helps keep your portfolio safe from those costly knee-jerk reactions. What is the biggest investing mistake? The biggest investing mistake is usually trying to time the market instead of staying consistent for the long haul. Trying to chase quick gains often backfires, so sticking to your strategy is always the safer bet. What is an ETF? An ETF is basically a big basket of different securities, like stocks or bonds, that you can buy and sell all at once, just like a single share. How does an ETF work? An exchange-traded fund works by pooling money from many investors to purchase a broad collection of assets, which lets you trade the whole bundle on the stock exchange throughout the day, just like a regular share. What is an index fund? An index fund is a type of mutual fund, or ETF, designed to track the performance of a specific market index, like the S&P 500. It is a fantastic way to get instant diversification without having to pick individual companies yourself. How is an ETF different from a mutual fund? An exchange-traded fund gets bought and sold on public exchanges all day long just like a regular stock, whereas traditional mutual funds only price and trade once at the end of the trading day. What is an actively managed fund? actively managed fund relies on professional portfolio managers who regularly buy and sell securities to try and beat the overall market returns. What is a passively managed fund? A passively managed fund is a portfolio designed to match the performance of a specific market benchmark rather than trying to beat it. Because they require less active trading, they usually come with much lower fees. What is an index? An index serves as a statistical benchmark that tracks the collective performance of a specific group of companies in the market. How are stock market indexes created? Stock indexes are put together by selecting a specific group of companies that represent a particular market or sector, and then weighting them based on their size or value. What is the S&P 500? The S&P 500 is a major stock market index that measures the performance of 500 of the largest publicly traded companies in the United States. It is widely considered one of the best gauges of the overall health of the American economy. What does the S&P 500 represent? The S&P 500 tracks 500 of the biggest companies in the US, acting as a great snapshot of how the broader market is doing. What is the Nasdaq? The Nasdaq is a major stock exchange that heavily features tech and growth companies, making it a great gauge for how the technology sector is performing. What is the Dow Jones? The Dow Jones is a famous stock market index that tracks 30 major publicly traded companies in the United States to give a quick pulse on how big businesses are doing. What is the Russell 2000? The Russell 2000 is a stock market index that follows 2,000 smaller American companies, giving us a great look at how smaller businesses are performing. What is a total market index? A total market index aims to capture the performance of almost an entire stock market by including thousands of large, medium, and small companies, giving you a broad view of the whole economy. What is an international ETF? An international ETF is a fund that lets you invest in companies located outside of your home country, giving you instant global diversification. What is an emerging markets ETF? An emerging markets ETF is an investment fund that focuses on the stock markets of developing countries experiencing rapid economic growth, like Brazil or India. What is a sector ETF? A sector ETF is an investment fund that gathers companies from one specific industry, like healthcare or energy, allowing you to target a particular area of the market. What is a technology ETF? A technology ETF is an investment fund that bundles together companies from the tech industry, letting you easily invest in a bunch of software and hardware businesses at once. What is a financial sector ETF? A financial sector ETF is a specialized investment fund that groups together banks, insurance companies, and other financial institutions, so you can invest in the whole banking industry at once. What is a dividend ETF? A dividend ETF is a collection of companies that regularly pay out a portion of their earnings to shareholders as cash, which is a fantastic way to generate passive income. What is a bond ETF? A bond ETF is a basket of fixed income securities like government or corporate bonds that trades on an exchange just like a regular stock, making it super easy to earn steady interest payments. What is a commodity ETF? A commodity ETF lets you invest in physical goods like gold, oil, or agricultural products through shares on an exchange without having to store the actual items yourself. What is a leveraged ETF? A leveraged ETF uses financial derivatives and debt to try and multiply the daily returns of an underlying index, though it also increases your risk quite a bit. Why are leveraged ETFs risky? Leveraged ETFs are risky because they use borrowed money and financial derivatives to amplify daily market moves, which can quickly wipe out your gains if the market drops. What is an inverse ETF? An inverse ETF is designed to profit when the underlying market index falls, using short positions and derivatives to move in the exact opposite direction of the market. How does an inverse ETF work? An inverse ETF uses short selling and financial derivatives so that its value goes up when the target market index goes down. What is ETF tracking error? Tracking error measures how much an ETF's performance deviates from the actual index it is supposed to follow. It is super helpful for seeing how well the fund manager is doing their job. What is an ETF expense ratio? An ETF expense ratio is the annual fee you pay to the fund manager to cover operating costs, which is automatically deducted from the fund's assets. Why do expense ratios matter? Expense ratios matter because those yearly fees eat into your overall investment returns over time. So finding lower cost funds helps you keep more of your hard-earned profits. What is a fund's assets under management? Assets under management refers to the total market value of all the investments that a specific fund manages for its investors at any given time. What is ETF liquidity? ETF liquidity basically means how quickly and easily you can buy or sell shares of the fund without changing its market price too much. Funds with higher daily trading volume and liquid underlying holdings are usually much smoother to trade. What is bid-ask spread? The bid-ask spread is basically the gap between the highest price a buyer is willing to pay and the lowest price a seller is willing to accept for an asset. It is a key part of trading costs you want to keep an eye on. Why does the bid-ask spread matter? The bid-ask spread matters because it represents an immediate transaction cost when you buy and sell, meaning a wider gap eats into your returns right from the start. What is ETF creation and redemption? Creation and redemption is the clever mechanism authorized participants use to keep an ETF's market price closely aligned with its net asset value by swapping baskets of securities for shares, or vice versa. What is an ETF premium? An ETF premium happens when the fund's market price rises higher than the actual net value of its underlying assets. It usually pops up when demand to buy the shares shoots up quickly. What is an ETF discount? An ETF discount happens when the market price of the fund drops below the actual net value of its underlying holdings, usually because more people are selling than buying at that moment. What is a mutual fund? A mutual fund pools money from many investors to purchase a diversified portfolio of stocks, bonds, or other securities managed by a professional. It is a great way to spread out your risk without having to pick individual investments yourself. What is a money market fund? A money market fund is a type of mutual fund that invests in super safe, short-term debt instruments like cash and government securities. It is a really popular choice if you want to keep your cash secure while still earning a little bit of interest. What is a balanced fund? A balanced fund is an investment portfolio that holds a mix of both stocks and bonds to give you a blend of growth and income stability. What is a target date fund? A target date fund automatically shifts its asset mix to become more conservative as you approach your planned retirement year. What is a life cycle fund? A life cycle fund is basically another name for a target date fund that adjusts your investments to be safer as you age. What is a closed-end fund? A closed-end fund issues a fixed number of shares through an initial public offering, and those shares then trade on a secondary market, just like regular stocks. Because of this setup, the market price can end up trading at either a discount or a premium compared to the actual value of the underlying assets. How does a closed-end fund differ from an ETF? Unlike open-ended ETFs that can create or redeem shares on the fly, closed-end funds issue a static pool of shares that trade purely on the open market. What is a dividend? A dividend is a portion of a company's earnings that gets paid out regularly to its shareholders as a nice little reward for investing. It is a super popular way to generate some extra passive income from your portfolio. Why do companies pay dividends? Businesses distribute dividends to share their profits with investors and make holding their stock more attractive. It is a fantastic way to reward shareholders for sticking with the company over the long haul. What is dividend yield? Dividend yield tells you how much cash a company pays out each year relative to its share price, expressed as a neat little percentage. How is dividend yield calculated? You figure out dividend yield by taking the annual payout per share and dividing it by the current share price, then multiplying by 100 to get your percentage. What is dividend growth? Dividend growth happens when a company consistently increases the amount of cash it pays out to shareholders year after year. It is usually a great sign that the business is growing and wants to share those extra profits with us. What is dividend payout ratio? The dividend payout ratio shows the percentage of earnings a company distributes to its shareholders as cash dividends. It is calculated by dividing the total dividends paid by the net income. What is dividend coverage? Dividend coverage is a handy metric that shows us how easily a company can pay its dividends using its net income. You figure it out by dividing the earnings per share by the annual dividend per share, which helps us see if those payouts are safe and sustainable. What is a dividend aristocrat? A dividend aristocrat is an elite company in the S&P 500 that has successfully increased its dividend payouts every single year for at least 25 consecutive years. It shows incredible financial strength and reliability. What is a dividend king? A dividend king takes things a step further than aristocrats by increasing payouts for over 50 consecutive years. It is an amazing badge of honor showing incredible financial stability. Why do companies cut dividends? Businesses usually reduce their payouts when they face financial difficulties, such as dropping profits or tight cash flow. They do this to protect their core operations and keep the business running safely. What happens when a company suspends its dividend? When a company suspends its dividend, it completely halts those cash distributions to shareholders, usually to preserve cash during tough times. It can definitely be disappointing for investors who rely on that income, but it helps the business secure its financial footing. What is dividend reinvestment? Dividend reinvestment is a great strategy where you automatically use your cash payouts to buy more shares of that same company without paying extra fees. It helps your investment grow much faster over time through compounding. What is a DRIP? A DRIP, or dividend reinvestment plan, lets you automatically roll your cash distributions right back into purchasing extra shares. It is a fantastic way to snowball your portfolio over time without paying any extra broker fees. How does dividend reinvestment create compounding? Dividend reinvestment creates compounding by taking your cash payouts and instantly buying fractional shares, which then earn their own dividends moving forward. Over time, those extra shares start generating their own returns, causing your portfolio to snowball much faster. Is dividend investing better than growth investing? Choosing between dividend and growth investing really comes down to your personal goals. Dividend investing focuses on generating steady cash flow today, while growth investing aims for bigger price gains down the road. Are dividends free money? Dividends are definitely not free money since they come directly out of the company's valuation when paid out. It is basically just getting a portion of the company's earnings handed right back to you. How does a stock price change after a dividend? When a company pays out a dividend, its share price usually drops by roughly that exact same cash amount on the ex-dividend date. That happens because money is literally leaving the business to go straight into the pockets of shareholders, which slightly lowers the overall corporate valuation. What is an ex-dividend date? The ex-dividend date is the crucial deadline where you need to own the stock to qualify for the upcoming payout. If you buy shares on or after that day, the previous owner gets the cash distribution instead. What is a record date? The record date is the specific day set by a company to determine which shareholders are officially on the books to receive the upcoming dividend payout. What is a payment date? The payment date is simply when the company actually sends the dividend cash directly to your brokerage account. It is the final step where the money officially lands in your hands. What is a declaration date? The declaration date is when a company officially announces its upcoming dividend amount, along with the timeline for payouts. It is the exciting moment everyone finds out how much cash distribution is heading their way. What is dividend capture? Dividend capture is a short-term trading strategy where someone buys a stock just before the ex-dividend date to collect the payout and then sells it right after the price adjusts. It sounds simple, but you have to factor in transaction costs and potential price drops. Does dividend capture really work? Dividend capture can work on paper, but after factoring in trading commissions and taxes, it usually isn't as profitable as people hope. Plus, waiting for the share price to recover can sometimes take longer than expected. What is total return? Total return is the complete measure of an investment's performance, factoring in both capital appreciation and any income like dividends or interest. It gives you the full picture of how much your money has actually grown. Why is total return important? Total return matters because it shows your complete investment gains by combining both price growth and any cash payouts you received. Relying solely on share price changes would leave out valuable income that truly boosts your overall earnings. How is total return calculated? Total return is figured out by adding up all your capital gains or losses, along with any dividends or interest you received, and then dividing that total by your initial investment. What is capital appreciation? Capital appreciation happens when an asset increases in value over time compared to what you originally paid for it. It is all about watching your investments grow and build wealth. What is income return? Income return measures the cash generated by an investment, like dividends or interest, relative to its price. It helps you see how much regular money your portfolio is actually kicking back to you. What is a distribution? A distribution is simply a payment made by an investment fund or company to its shareholders, often including dividends, capital gains, or interest earned. It is a nice way to receive some cash flow from your holdings. How are ETF distributions generated? ETF distributions come from the dividends paid by the underlying stocks or interest from the bonds held inside the fund. The fund manager simply collects these earnings and passes them along to us. What is a capital gains distribution? A capital gains distribution happens when a mutual fund or ETF sells underlying assets for a profit and passes those realized gains directly on to the shareholders. It is essentially a way to share the portfolio's realized profits with everyone invested in the fund. What is fund turnover? Fund turnover measures how frequently a mutual fund or ETF buys and sells its portfolio holdings over the course of a year. A higher rate means the manager is actively trading inside the fund, which can sometimes lead to extra costs and tax impacts. Why does fund turnover matter? High portfolio turnover means the fund manager is frequently buying and selling assets, which can rack up higher transaction fees and create extra tax headaches for investors. What is tax efficiency? Tax efficiency is all about how well an investment minimizes the impact of taxes, so you get to keep more of your hard-earned returns. Funds with lower turnover tend to trigger fewer taxable events, making them a great choice for keeping your tax bill manageable. Why can ETFs be tax efficient? ETFs are usually very tax efficient because their unique creation and redemption process helps avoid triggering capital gains taxes compared to standard mutual funds. What is an accumulating ETF? An accumulating ETF automatically reinvests any dividends or interest it earns right back into the fund, instead of paying them out to you in cash. This is super handy for growing your wealth over time without having to manually buy more shares yourself. What is a distributing ETF? A distributing ETF actually pays out any dividends or interest it collects directly to your cash account instead of reinvesting them. It is a fantastic choice if you are looking to generate some regular income from your portfolio. What is synthetic ETF exposure? Synthetic ETFs use swap agreements with financial institutions to track an index rather than physically owning the underlying stocks. It is a clever way to gain exposure to tricky markets, though it does add a little bit of counterparty risk. What is physical ETF replication? Physical replication simply means the fund actually buys and holds the exact stocks or bonds that make up the index it is trying to track. It is a straightforward approach because you truly own the underlying assets. What is equal weight investing? Equal weight investing is a strategy where you put the exact same dollar amount into every single company in a portfolio, rather than weighting them by size. This means smaller companies get just as much emphasis as the tech giants. What is market cap weighting? Market cap weighting is an investment method where companies are held in the portfolio based on their total market value, meaning larger corporations make up a much bigger slice of the fund. What is fundamental weighting? Fundamental weighting is a method where companies in an index are ranked and chosen based on economic size factors like sales, earnings, or dividends, rather than just their stock price or total market value. What is factor-based ETF investing? Factor-based investing targets specific characteristics like value, momentum, or size to try and outperform standard market indexes. It is a neat way to tilt your portfolio toward particular traits you believe will deliver stronger results over time. What is smart beta investing? Smart beta investing blends traditional indexing with active strategies by using specific rules to pick and weight stocks. It aims to beat standard market returns while keeping costs relatively low. What is a covered call ETF? A covered call ETF is a fund that holds a basket of stocks and simultaneously sells call options on those shares to generate extra premium income. It can be a neat way to boost cash flow, though it might limit your upside potential if the market rallies strongly. How do covered call ETFs generate income? Covered call ETFs bring in cash by selling options contracts on the stocks they already own, which gives them extra premiums. It is a clever approach for boosting regular payouts, though it can cap your gains if the market shoots up. What are the risks of covered call ETFs? Covered call funds can miss out on big market rallies because the options they sell cap your potential gains. Plus, if the underlying stocks drop significantly, you still take those losses since the premiums only offer a tiny cushion. What is a high-yield ETF? A high-yield ETF is a fund that focuses on holding assets like corporate bonds or dividend-paying stocks that pay out higher than average regular distributions. It is a fantastic option for anyone wanting to boost their cash flow, though those higher payouts sometimes come with extra credit or market risk. Why might a high yield be a warning sign? An unusually high yield often signals higher risk because the company might be facing serious financial trouble or its share price has dropped drastically. It is always wise to dig into the fundamentals rather than just chasing the biggest payout. What is yield chasing? Yield chasing happens when folks jump into investments solely because they offer the highest payouts, often ignoring the hidden risks underneath. It can be pretty dangerous since those massive distributions sometimes point to struggling businesses. Why is yield chasing dangerous? Chasing high yields can be risky because those oversized payouts often hide underlying financial trouble or a crashing stock price. It is usually much safer to check the fundamentals instead of just looking at the payout size. What is fund concentration? Fund concentration happens when a portfolio holds a heavy amount of its assets in just a few specific stocks or sectors. While it can lead to massive gains if those particular holdings perform exceptionally well, it also exposes your money to much higher risk if those few areas take a downturn. How can you measure ETF diversification? You can measure how diversified an ETF is by checking its holdings report to see how heavily weighted the top assets are and how many different sectors it covers. Should investors own multiple overlapping ETFs? Owning overlapping ETFs usually means you are just doubling up on the exact same underlying assets rather than truly diversifying. It can make your portfolio top-heavy in certain areas without adding any real variety to your investments. What causes ETF overlap? ETF overlap happens when different funds purchase the exact same underlying companies, meaning you are unintentionally doubling your exposure to those specific names. How can investors simplify their portfolios? Investors can easily streamline their portfolios by consolidating duplicate funds and focusing on broad market index products that cover thousands of companies at once. What makes an ETF attractive for long-term investors? ETFs are fantastic for long-term investing because they give you instant diversification across hundreds of companies in a single trade, which helps lower your overall risk. Plus, they usually come with much lower management fees compared to picking individual stocks yourself. What is a stock option? A stock option is a contract that gives you the right to buy or sell a specific company's shares at a set price before a certain date. It is a neat derivative tool, though it definitely carries extra complexity compared to holding standard shares. What is a call option? A call option gives you the chance to buy a stock at a set price before a specific date, which can be pretty profitable if the share price climbs high enough. What is a put option? A put option gives the holder the right to sell shares at a set price before the expiration date, which can protect against a falling market. Why would someone buy a call? Traders typically purchase a call option when they expect a stock's price to rise significantly before the contract expires. It lets them lock in a lower purchase price and capture the upside potential without needing to buy the actual shares up front. Why would someone buy a put? Purchasing a put gives someone the right to sell shares at a set price, which acts like insurance to protect their portfolio if the market drops. What is an option strike price? The strike price is the pre-agreed amount at which you can buy or sell the underlying shares when using an option contract. It is a key detail that determines whether your trade will turn a profit. What is an expiration date? The expiration date is the absolute deadline for when an option contract becomes invalid. You have to make your move or close the trade before that exact time arrives. What is option premium? An option premium is simply the upfront price you pay to purchase the contract itself. It acts as the market value for that specific right to buy or sell later on. What is intrinsic value? Intrinsic value is the actual calculated worth of a company, determined by looking at its core financials and future cash flows, rather than just its current market price. What is extrinsic value? Extrinsic value is the extra monetary worth added to an option contract based on things like time remaining until expiration and market volatility. It represents the potential for the contract to become even more profitable before the final deadline. What is time value? Time value is a portion of an options premium that depends on how much time is left until the contract expires. As the deadline gets closer, that extra worth naturally fades away. What is implied volatility? Implied volatility measures how much the market expects a stock's price to fluctuate going forward, which heavily influences option prices. What is historical volatility? Historical volatility calculates how much a stock's price has bounced around in the past by looking at its past trading data. It helps traders gauge how stable or wild the price movements have been over a specific time frame. How does volatility affect option prices? When volatility goes up, the price of the option generally increases because there is a higher chance of a big price swing before the deadline. It makes the contract much more exciting for traders. What is the options chain? An options chain is basically a detailed list of all available call and put options for a specific stock, showing prices and expiration dates in one handy view. What is open interest? Open interest simply tracks the total number of active options contracts that haven't been settled yet. It is a super helpful way to see how much market liquidity and interest there is in a specific trade. What is options volume? Options volume simply counts the total number of contracts traded during a single trading session. It is a fantastic way to see which trades are getting the most attention right now. What is the bid price for an option? The bid price is the highest amount a buyer is currently willing to pay for that specific option contract. It is the exact number you would look at if you wanted to sell your contracts right away. What is the ask price for an option? That's a great question. What are your thoughts on it? What is an option spread? An option spread involves buying and selling multiple contracts on the same stock at the same. What is the bid-ask spread in options? The bid-ask spread is the gap between the highest price a buyer wants to pay and the lowest price a seller is willing to accept for an option contract. A tighter spread usually means the market is more active and easier to trade in. What is delta? Delta measures how much an option's price is expected to change when the underlying stock moves by $1. It helps traders gauge the sensitivity of their contracts. What does option delta measure? That's a great question. What are your thoughts on it? What is gamma? That's a great question. What are your thoughts on it? What does gamma measure? Gamma tracks the rate of change in an option. What is theta? That's a great question. What are your thoughts on it? Why does theta matter? Theta measures how much an option's value decreases each day as it gets closer to its expiration date. It is super important for anyone holding contracts because time decay works against you if you are a buyer. What is Vega? Vega shows how much an option's price is. What does Vega measure? That's a great question. What are your thoughts on it? What is Rho? Rho measures how much an option's price changes when interest rates shift. It is particularly helpful to watch when you are looking at longer-term contracts. What does Rho measure? Here is the JSON requested. JSON. What is an at-the-money option? That's super interesting. Tell me more about it. What is an in the money option? I love how that works out. What else is on your mind? What is an out of the money option? That's a great question. What are your thoughts on it? What is a deep in the money option? That's a great question. What are your thoughts on it? What is a covered call? That's a great question. What are your thoughts on it? Why do investors sell covered calls? That completely makes sense. What's your next move? What are the risks of covered calls? Here is the JSON requested. What is a cash secured put? That's a great question. What are your thoughts on it? Why sell cash secured puts? That's a great question. What are your thoughts on it? What is a protective put? That's a great question. What are your thoughts on it? What is a collar strategy? That's a great question. What are your thoughts on it? What is a bull call spread? That's a great question. What are your thoughts on it? What is a bear put spread? A bear put spread is an option strategy. What is a bull put spread? A bull put spread is What is a bear call spread? It's an option setup where you sell a What is an iron condor? An iron condor is an advanced option strategy where you sell a put spread and a call spread at the same time to collect premium. It works best when you expect the stock price to stay right in a specific range. What is an iron butterfly? An iron butterfly is a neutral trading strategy that combines What is a straddle? A straddle is when you buy both a call. What is a strangle? With a strangle, you buy both a call and. When might a trader use a straddle? A trader usually goes for a straddle when they expect a huge price move in either direction, but they just aren't sure which way it'll go, like right before a major earnings report. When might a trader use a strangle? Traders typically opt for. What is a calendar spread? A calendar spread is when you simultaneously. What is a diagonal spread? A diagonal spread involves buying one option contract while simultaneously selling another of the same type, but with different strike prices and different expiration dates. It essentially blends a vertical spread and a calendar spread. What is a vertical spread? A vertical spread means you're buying and selling. What is an options assignment? Options assignment happens when you've sold a contract. is early assignment? Early assignment happens when an option buyer exercises. What is exercise? Exercising an option means deciding to use the right. What happens when an option expires? That's a great question. What are your thoughts on it? What is expiration risk? Expiration risk is the danger you face when What is pin risk? Pin risk is that tricky situation where an option expires right at the strike price, leaving you totally unsure if you will end up with shares or not over the weekend. What is gamma risk? Gamma risk refers to how fast an option's delta can change when the underlying stock price moves, which usually happens right near expiration. What is volatility crash? Volatility crush is that sudden drop in option prices right after a big event like an earnings report passes, because the uncertainty is finally gone. Why can options lose value after earnings? Option prices build, and a lot of extra value do. What is an earnings IV crush? An earnings IV crush is the sudden collapse of option prices right after a company drops its earnings report, simply because the major uncertainty has finally vanished. Why does implied volatility rise before earnings? Implied volatility climbs ahead of an earnings release because everyone is waiting to see how the company performs. That huge buildup of uncertainty pushes option prices higher until the news finally drops. What is an earnings straddle? An earnings straddle is a strategy where you buy both a call and a put option with the same strike price ahead of an earnings announcement to profit from a massive price swing in either direction. What is options flow? Options flow basically tracks large institutional trades in real time, which helps us see where the big market players are placing their bets. What is unusual options activity? Unusual options activity happens when someone trades a way higher volume of contracts than normal for a specific stock, which usually hints that big institutional investors are anticipating a major price move soon. Can options flow predict stock prices? Options flow doesn't guarantee future prices, but it gives us a great look at where big institutional players are putting their money so we can spot potential momentum. What is gamma exposure? Gamma exposure measures how much market makers need to buy or sell the underlying stock to keep their portfolios balanced as the price shifts. What is dealer gamma? Dealer gamma is essentially the rate at which market makers have to adjust their stock hedges when the underlying price changes. It can really amplify market movements depending on whether dealers are net positive or negative. What is delta hedging? Delta hedging is a risk management technique where traders buy or sell the underlying asset to make their overall position neutral against price changes in the market. What is market maker hedging? Market maker hedging is when financial institutions buy or sell shares of stock to balance out their risk from options they sold to clients. It keeps their portfolio neutral so they don't lose money if the market suddenly swings. What is a 0 days to expiration option? A 0 days to expiration option is a contract that expires on the exact same trading day it is bought, which makes it super popular for quick day trades. Why are 0 DTE options risky? Zero days to expiration options carry high risk because they lose value extremely fast and expire on the exact same day you buy them, leaving no time for a losing trade to recover. What is leverage? Leverage is basically using borrowed money or financial instruments like options to boost your potential investment returns. It can really increase your profits, but it also ramps up your risk just as fast. Why can options create large gains? Options can lead to massive gains because they give you control over a large block of shares for a fraction of the stock's actual price, creating a powerful multiplier effect when the market moves in your favor. Why can options create large losses? Options can cause steep losses because contracts can easily expire completely worthless if the stock price doesn't move the way you hoped. What is margin trading? Margin trading lets you borrow funds from your broker so you can buy more shares than you could with just your own cash. It can definitely boost your potential profits, but it also increases your risk of big losses if the market drops. What is a margin call? A margin call happens when the value of your borrowed investments drops too low, and your broker asks you to deposit more cash or sell assets to cover the deficit. What triggers a margin call? A margin call happens when your account balance dips below the required maintenance level because the securities you bought on borrowed money dropped in value. Your broker will then ask you to deposit more cash or sell off some assets to fix the shortfall. What is buying power? Buying power is the total cash and available margin in your account that you can use to purchase securities right away. It lets you trade with more than just your own deposited funds. What is maintenance margin? Maintenance margin is the minimum amount of equity you need to keep in your brokerage account after buying securities on borrowed money. If your account value falls below that threshold, your broker will issue a margin call. What is initial margin? Initial margin is the cash percentage you need to put down upfront when buying securities on credit. What is a stop-loss order? A stop-loss order is an instruction you give your broker to sell a stock automatically if it drops to a certain price, which helps limit your potential losses. What is a limit order? A limit order lets you set a specific price at which you want to buy or sell a stock, so the trade only happens if the market reaches your exact target. What is a market order? A market order is a request to buy or sell a stock right away at the current best available price in the market. It guarantees execution, though the final price might shift slightly by the time the trade goes through. What is a stop limit order? A stop limit order combines features of both stop and limit orders by triggering a specific limit price once your chosen stop threshold is reached, giving you precise control over your trade execution. What is a trailing stop? A trailing stop is a special order that adjusts automatically as the stock price rises, helping you lock in gains while keeping a safety net below if the market turns downward. What is slippage? Slippage occurs when your trade executes at a different price than you expected, usually because the market moved too fast while your order was processing. What is liquidity risk? Liquidity risk pops up when you need to sell an asset quickly, but there just aren't enough buyers around, forcing you to accept a lower price than you wanted. What is execution risk? Execution risk is the hazard that your trade might not go through at the exact price or time you wanted, because market conditions shifted too quickly. What is position sizing? Position sizing is simply figuring out how many shares or units of an asset to buy, so you don't risk too much of your total money on a single trade. It's a super helpful way to keep your portfolio safe and balanced. Why is position sizing important? Determining your trade size carefully prevents any single market move from wiping out your account. It helps you manage risk and stay in the game for the long haul. What is risk-reward ratio? The risk-reward ratio compares how much money you stand to lose on a trade against the potential profit you could make. It is a fantastic tool to figure out if a setup is worth taking before you jump in. What is a trading edge? A trading edge is simply a strategy or advantage that gives you a better than random chance of making profitable trades over the long run. It is what separates successful traders from everyone else. What is a trading strategy? A trading strategy is just a structured game plan that outlines exactly when you should buy and sell assets. Having a solid plan helps take the guesswork and emotion out of your financial decisions. What is overtrading? Overtrading happens when someone buys and sells assets way. Why do traders lose money? Traders often take losses because they let emotions guide their decisions or fail to use proper risk management like stop-loss orders. Sticking strictly to your game plan makes a huge difference in staying profitable. What is economics? Economics is basically the study of how people, businesses, and governments make choices about using scarce resources to satisfy their wants and needs. What is supply and demand? Supply and demand is the basic economic rule that determines the price of things based on how much of it is available and how badly people want to buy it. How does supply affect prices? When the supply of something goes up while demand stays the same, the price usually drops because there's plenty to go around. On the flip side, if an item becomes super rare, sellers can charge more for it. How does demand affect prices? When consumer desire for an item climbs, while the available quantity stays the same, prices naturally rise because people are willing to pay more to get it. What causes inflation? Inflation usually happens when too much money chases too few goods, or when the overall cost of producing items goes up significantly. What is inflation? Inflation is essentially the gradual increase in prices over time, which reduces the purchasing power of your money. What is core inflation? Core inflation is a special measure that tracks price changes while leaving out food and energy costs, which tend to bounce around a lot. This helps us see the steady, underlying trend of inflation much more clearly. What is headline inflation? Headline inflation is the raw rate of overall price increases across an entire economy, including volatile items like groceries and fuel. It provides a complete look at how the actual cost of living is changing for everyday shoppers. What is the Consumer Price Index? A Consumer Price Index is a handy gauge that measures the average change in prices paid by urban consumers for a market basket of everyday goods and services over time. What does CPI measure? The Consumer Price Index tracks how the average prices paid by consumers for a standard basket of goods and services shift over time. What is the Producer Price Index? Producer Price Index is a helpful metric that tracks the average changes in selling prices received by domestic producers for their output. It basically shows us how manufacturing costs are shifting before those price tags ever hit the store shelves. What does PPI measure? The Producer Price Index tracks the average changes in selling prices that domestic producers receive for their goods and services. Why does inflation matter to investors? Inflation matters so much to investors because it eats away at your purchasing power over time, meaning your money buys less later on. Because of that, people look for investments that can actually grow faster than the rate of price increases. What causes deflation? Deflation typically happens when a wave of technological innovation lowers production costs, or when overall consumer spending drops significantly across the board. What is disinflation? Disinflation is simply a slowdown in the rate of inflation, meaning prices are still going up, but at a slower pace than before. What is hyperinflation? Hyperinflation is an extreme and rapid surge in prices that completely overwhelms the value of local currency. It usually happens when governments print far too much money to cover their debts, making everyday items extraordinarily expensive. What is stagflation? Stagflation is a really tricky economic situation where slow economic growth happens at the same time as high unemployment and rising prices. It is pretty rare because prices usually do not go up rapidly when the economy is struggling. What is monetary policy? Monetary policy is basically how a central bank manages the country's money supply and interest rates to keep the economy healthy and stable. What is fiscal policy? Fiscal policy involves the government using its spending powers and tax policies to influence the overall direction of the economy. Who controls monetary policy? Central banks, like the Federal Reserve here in the US, are the ones that take charge of managing monetary policy. What is a central bank? A central bank is the main financial institution that oversees a country's monetary system, regulates commercial banks, and sets interest rates to keep the economy steady. What does a central bank do? A central bank acts as the main authority regulating a nation's money supply, supervising commercial banks, and setting key interest rates to maintain economic stability. Why do central banks raise interest rates? Central banks push borrowing costs higher to cool down spending and get a handle on rising price levels. It is a main tool they use to stabilize the broader economy. Why do central banks lower interest rates? Central banks lower interest rates to make borrowing cheaper, which encourages people and businesses to spend and invest more to boost a sluggish economy. How do interest rates affect stocks? When interest rates go up, borrowing gets pricier for companies, which can sometimes slow down their growth and put a bit of pressure on stock prices. How do interest rates affect bonds? When interest rates rise, existing bond prices usually drop because newer bonds offer better payouts, making the older ones less attractive to buyers. How do interest rates affect housing? When interest rates go up, getting a mortgage becomes more expensive, which usually cools down the housing market because fewer people can afford to buy homes. How do interest rates affect consumers? Interest rates directly impact everyday people by making loans, credit cards, and mortgages either more expensive or cheaper to pay off. When rates drop, borrowing becomes much more affordable, which usually gives everyone a bit more breathing room for their monthly spending. How do interest rates affect businesses? Higher rates make taking out loans for What is the federal funds rate? The federal funds rate is simply the interest rate that banks charge each other for overnight loans, which helps set the tone for all kinds of other borrowing costs in the economy. What is the policy rate? The policy rate is the specific benchmark interest rate set by a central bank to manage monetary policy and steer the overall economy. What is quantitative easing? Quantitative easing is a special monetary policy where central banks buy financial assets to inject money directly into the economy and encourage lending. What is quantitative tightening? Quantitative tightening is when central banks reduce their balance sheets by letting bonds mature or selling them outright to pull money out of the financial system and slow down inflation. How does quantitative easing affect markets? Quantitative easing pumps liquidity straight into the financial system, which typically drives asset prices higher and encourages investors to take on more risk. How does quantitative tightening affect markets? When central banks roll out quantitative tightening, it pulls liquidity out of the system, which can cause asset prices to pull back as money becomes less abundant. What is a central bank balance sheet? A central bank's balance sheet is basically a big financial statement showing all the assets it holds, like government bonds, and the liabilities it owes, like currency in circulation. What is a rate hike? A rate hike is when the central bank decides to push its benchmark interest rate up to help cool down inflation. It usually means that borrowing money for things like cars or houses gets a bit more pricey. What is a rate cut? A rate cut is when the central bank lowers its main borrowing rate to stimulate economic activity by making loans cheaper for everyone. What is a pause in monetary policy? A policy pause is when the central bank decides to hold interest rates steady for a bit to see how past adjustments are affecting the economy before making their next move. What is forward guidance? Forward guidance is just a fancy term for when central banks give us a heads up about where they plan to take interest rates in the future. It really helps everyone plan their finances better. What is a yield curve? A yield curve is simply a line graph that compares interest rates on bonds across different time periods, usually showing that longer-term bonds pay higher rates than short-term ones. What is a normal yield curve? A standard yield curve slopes upwards, showing that investors expect higher compensation for lending their money over longer periods compared to short-term loans. What is an inverted yield curve? An inverted yield curve happens when short-term interest rates end up higher than long-term ones, and it's often watched closely because it has historically signaled a potential economic slowdown. Why does the yield curve matter? The yield curve is super important because economists and investors watch it closely to gauge the overall health of the economy and spot potential shifts ahead. What is a yield curve inversion? An inversion happens when short-term debt pays better than long-term bonds, which people watch because it is often pointed toward economic trouble ahead. Can yield curve inversions predict recessions? Historically, when short-term yields top long-term ones, it has often served as a reliable warning sign for an upcoming economic downturn. Economists and market pros keep a very close eye on it for precisely that reason. What is a recession? A recession is basically a period of significant economic decline, where business activity slows down over several months. It's usually measured by a drop in the gross domestic product. What defines a recession? A recession officially gets called when the country sees a drop in economic output for 2 quarters in a row. It basically means businesses and overall financial activity are slowing down for a bit. What is GDP? GDP stands for Gross Domestic Product, which is basically the total value of all the goods and services a country produces. It's often used as the main scorecard to see how healthy and growing an economy is. How is GDP calculated? Gross domestic product is calculated by adding up total consumer spending, business investments, government purchases, and net exports. It gives us a complete picture of everything our economy produces. What is real GDP? Real GDP takes our total economic output and adjusts it for inflation, giving us a much clearer picture of actual growth without price changes getting in the way. is nominal GDP? Nominal GDP measures the total value of all goods and services produced at current market prices, without adjusting for inflation. What is GDP per capita? GDP per capita takes the total economic output of a country and divides it evenly by its population. It's a handy way to see the average economic well-being or standard of living for each person. What is economic growth? Here is the JSON requested, JSON. What causes economic growth? Economic growth is primarily driven by consumer spending, business investments, government outlays, and net exports. When all these areas expand together, the overall output of the country goes up. What is productivity? Productivity measures how efficiently we produce goods and services using our available labor and resources. Higher productivity generally leads to stronger economic growth and better living standards for everyone. Why is productivity important? Productivity is super important because it helps us get more done with the same amount of effort, which ultimately drives higher wages and better living standards for everyone. What is unemployment? Unemployment happens when people who are actively looking for a job can't find one, and the rate shows what percentage of the total workforce is currently out of work. What is the unemployment rate? The unemployment rate tells us the percentage of folks in the labor force who are currently searching for work but haven't landed a job yet. What is the labor force participation rate? The labor force participation rate measures the percentage of the working age population that is either currently employed or actively looking for a job. It is a fantastic metric for seeing how many people are engaging in the economy. What is underemployment? Underemployment happens when folks are working part-time, even though they want full-time jobs, or they are stuck in roles that don't use their actual skills and education. What is wage inflation? Wage inflation occurs when pay rates go up across the board, which can sometimes push businesses to raise their prices to keep up with the extra labor costs. How do wages affect inflation? When wages increase, businesses often pass those higher labor expenses onto consumers through steeper price tags to protect their profit margins. It creates a fascinating cycle between what people earn and what things cost in the market. What is consumer confidence? Consumer confidence is an economic indicator that measures how optimistic or pessimistic people feel about their financial situation and the overall state of the economy. When folks feel secure, they tend to spend more, which really helps drive the market forward. Why does consumer confidence matter? Consumer confidence is super important because when people feel optimistic about their financial futures, they are much more likely to open up their wallets and spend money, which helps keep the whole market moving forward. What is business confidence? Business confidence measures how upbeat company leaders feel about the economy and their future earnings. When executives are feeling positive, they are much more likely to hire new staff and invest in fresh projects. What is retail sales? Retail sales measure the total receipts at stores that sell merchandise to everyday shoppers. It is a fantastic way to gauge how much physical buying is happening in the economy. Why are retail sales important? Retail sales data gives us a really clear picture of consumer spending habits, which makes up a huge chunk of our overall economic health. When people are out shopping, it keeps businesses thriving and helps drive growth. What are durable goods? Durable goods are long-lasting items like cars or appliances that people expect to keep for a long time. Because they cost more, folks usually put a bit more thought into buying them. What are non-durable goods? Non-durable goods are products that get used up quickly, like food or paper products, usually lasting for less than 3 years. is industrial production? Industrial production is a monthly economic indicator that tracks the total output from manufacturing, mining, and utilities. It helps us see how strong our factories and energy sectors are performing. What is manufacturing PMI? The manufacturing PMI is a helpful monthly index that shows the health of the manufacturing sector based on surveys from factory bosses. If it sits above 50, it usually means the industry is expanding. What is services PMI? The services PMI is an index that tracks the economic health of the service sector, like hospitality and finance, based on surveys from business managers. When it reads above 50, it signals that the industry is growing nicely. What does PMI indicate? The Purchasing Managers Index gives us a quick What is an economic indicator? An economic indicator is a helpful data point that shows us how healthy our economy is doing overall. It gives us clues about employment, spending, and production. What is a leading indicator? A leading indicator is a handy metric that economists look at to help forecast where the economy might be heading next. It tries to spot future trends before they actually happen. What is a lagging indicator? A lagging indicator is a metric that changes after the overall economy has already begun to follow a specific trend or pattern. Economists use these to confirm shifts that are already taking place, rather than trying to predict what will happen next. What is a coincident indicator? A coincident indicator is a metric that moves right along with the current state of the economy, giving us a real-time pulse check on how things are going right now. What is the business cycle? A business cycle describes the natural ups and downs of economic activity over time, moving through periods of expansion and recession. It helps us understand where the economy is at in its overall growth journey. What are the stages of the business cycle? The business cycle generally moves through four main phases: expansion, peak, contraction, and trough. Each stage represents a different phase of economic growth and activity. What happens during an economic expansion? During an economic expansion, businesses grow, job opportunities increase, and overall consumer spending rises steadily. It is a really exciting phase where markets thrive and financial activity flourishes. What happens during a recession? During a recession, economic activity slows down significantly as businesses experience lower sales, companies pull back on hiring, and overall consumer spending drops. What happens during a recovery? During a recovery, the economy bounces back from a recession as businesses start hiring again and consumer demand picks up. It is all about rebuilding momentum and getting things moving in a positive direction. What is a depression? A depression is a severe and long-lasting form of economic downturn, where production drops sharply and unemployment stays extremely high for years. How is a depression different from a recession? A depression is much deeper and lasts way longer than a standard recession, with a massive drop in production and sky-high unemployment rates that stick around for years. What is a soft landing? A soft landing is when the central bank successfully cools down high inflation by raising interest rates without accidentally tipping the whole economy into a recession. What is a hard landing? A hard landing happens when aggressive steps to tame high inflation, unfortunately, push the economy straight into a severe downturn or recession. What is a productivity recession? A productivity recession happens when economic output per worker actually drops for a sustained period, even while total employment might still be growing. It usually means we are getting less efficiency out of our work hours. What is demand destruction? Demand destruction happens when high prices or tough economic times cause consumers to permanently cut back or stop buying certain goods and services. What is excess demand? Excess demand happens when the total desire for goods and services in the market outpaces what suppliers are currently able to produce. It typically leads to upward pressure on prices because buyers are competing for a limited supply. What is economic overheating? Economic overheating occurs when an economy grows way too fast, leading to severe supply bottlenecks and rapidly accelerating inflation. What is a credit cycle? A credit cycle describes the alternating waves of how easily banks lend money and how tightly they restrict credit over time. When lending is loose, businesses and consumers borrow heavily, but if things get risky, banks pull back and credit becomes much harder to get. What causes credit expansion? Credit expansion usually happens when interest rates are kept low, and banks feel really confident about lending money to people and businesses. That extra availability of cash makes it super easy to borrow, which fuels a lot of spending and investment. What causes credit contraction? Credit contraction happens when banks tighten their lending standards and make it much tougher to borrow money, usually because they are worried about economic risks. What is liquidity? Liquidity is basically how fast and easily you can turn an asset into cash without losing its value. Cash is the ultimate liquid asset because you can spend it right away. Why is liquidity important? Having good liquidity matters because it ensures you can quickly cover sudden expenses or grab new opportunities without having to sell things at a loss. What is market liquidity? Market liquidity refers to how easily you can buy or sell an asset without causing a major swing in its price. It is super important because high trading activity means transactions happen smoothly and quickly. What is monetary inflation? Monetary inflation happens when the central bank prints too much money, causing the overall supply of cash to grow much faster than the actual goods and services available in the economy. What is money supply? Money supply is simply the total amount of cash, coins, and balances in checking accounts circulating throughout the economy at any given time. How does money supply affect the economy? When the money supply grows too fast, it can spark inflation, while a tighter supply can slow down economic activity and spending. What is a mortgage? A mortgage is a special type of loan specifically used to purchase real estate, where the property itself acts as collateral until the debt is fully repaid. How does a mortgage work? When you get a mortgage, a lender provides the What is a fixed-rate mortgage? A fixed-rate mortgage keeps your interest rate and monthly principal and payment the exact same for the entire life of the loan, which makes planning your monthly expenses so much easier. What is a variable rate mortgage? A variable rate mortgage features an interest rate that can change periodically based on market conditions, meaning your monthly payments might go up or down over time. What is mortgage amortization? Mortgage amortization is the schedule showing how your monthly payments are split between paying off the principal loan amount and covering the interest charges over time. What is a mortgage term? A mortgage term is simply the specific length of time that your current loan agreement and interest rate are locked in place with the lender. What is a mortgage renewal? A mortgage renewal happens when your current loan term ends, and you sign a new agreement with your lender to keep borrowing the remaining balance for another set period. What is a mortgage down payment? A down payment is the initial cash amount you pay up front out of your own pocket when buying a home, which reduces the total size of the loan you need to borrow. Why does the down payment matter? Putting down more money upfront lowers your monthly loan payments and shows lenders you are a lower risk borrower, which can even help you secure a better interest rate. What is mortgage insurance? Mortgage insurance is a policy you usually have to buy if your down payment is less than 20%, and it protects the lender in case you fall behind on your loan payments. What is loan-to-value ratio? The loan-to-value ratio is a percentage that compares the amount of money you are borrowing to the appraised value of the property you want to buy. What is a mortgage stress test? A mortgage stress test is a financial check where lenders make sure you can still afford your payments if interest rates were to rise significantly in the future. How do mortgage rates affect home prices? When interest rates drop, monthly payments become more affordable, which often pushes home prices up because more buyers enter the market. Why do housing prices rise? Housing prices often climb when demand outweighs the available supply of homes on the market, or when borrowing costs become cheaper and bring in more buyers. Why do housing prices fall? Home values often drop when there are way more houses listed for sale than there are people looking to buy them, or when borrowing money becomes more expensive. What determines a property's value? A property's worth is mainly figured out through an appraisal, which looks at recent sales of similar homes nearby, its current condition, and overall market trends. What is rental yield? Rental yield measures the annual cash flow you earn from renting out a property compared to its total purchase price, helping you see how profitable an investment it really is. How do you calculate rental yield? To figure out rental yield, you take the total yearly income from rent, divide it by the property's purchase price, and multiply by 100 to get a helpful percentage. What is cash flow from real estate? Real estate cash flow is the leftover money you pocket each month after paying all your property expenses, like the mortgage and maintenance, out of your rental income. What is a cap rate? A cap rate, or capitalization rate, is the expected annual return on a real estate investment, calculated by dividing the net operating income by the property's current market value. How is cap rate calculated? You can figure out the cap rate by taking the property's net operating income and dividing it by its current market value. What is real estate appreciation? Real estate appreciation simply means that a property increases in value over time due to factors like neighborhood development and overall economic growth. What is real estate depreciation? Real estate depreciation is a tax deduction that lets property owners recover the cost of a building's wear and tear over time. What is leverage in real estate? Leverage in property investing means using borrowed money, like a bank mortgage, to buy real estate so you can boost your potential returns with less of your own cash up front. What are the risks of real estate leverage? Using borrowed money to buy property can amplify your losses just as easily as your gains, especially if property values dip or rental income suddenly drops. Plus, you still have to cover your mortgage payments every month even if the property sits empty. Hello, it is so wonderful to have you here with us on the stream today. What topics are we exploring next? What is a home equity? Home equity is simply the portion of your property that you truly own outright, calculated by subtracting your remaining mortgage balance from the current market value of the house. How does home equity build? Home equity grows as you pay down your mortgage principal each month, and as the overall market value of your house increases over the years. What is refinancing a mortgage? Refinancing a mortgage means replacing your current home loan with a brand new one, usually to score a lower interest rate or change your loan term. What is a home equity loan? A home equity loan lets you borrow money against the value you've built up in your house, giving you a lump sum that you pay back over time. What is a HELOC? A HELOC, or home equity line of credit, lets you borrow against the value of your house as needed, kind of like a credit card. What is a rental property? A rental property is real estate bought specifically to generate income from tenants through monthly lease payments. What makes a rental property profitable? A rental property brings in profit when the monthly rent you collect is higher than all your total expenses, like the mortgage, insurance, and maintenance costs. What is vacancy rate? Vacancy rate is the percentage of all available rental units that are currently sitting empty without tenants. Landlords always keep an eye on this metric to gauge market demand and potential income stability. What is property management? Property management involves hiring professionals or companies to handle the daily operations of rental real estate, from collecting rent to dealing with repairs, so landlords don't have to stress. What are operating expenses? Operating expenses are the day-to-day costs required to keep a property running, like utilities, property taxes, and routine maintenance. What is gross rental income? Gross rental income is the total amount of money a landlord collects from tenants before paying any bills or expenses. What is net operating income? Net operating income is the total revenue a property makes minus its day-to-day operating expenses, giving you a clear picture of its profitability. What is real estate cash-on-cash return? Cash-on-cash return measures the actual cash profit you earn compared to the total money you initially invested out of pocket. It is a great way to see how well your invested cash is performing. What is a REIT? The REIT, or Real Estate Investment Trust, lets people invest in large-scale properties without needing to buy or manage buildings themselves. How do REITs make money? REITs typically earn revenue by collecting rent from tenants living in their commercial or residential buildings, which they then pass on to investors as dividends. What are the advantages of REITs? Real estate investment trusts offer fantastic perks like effortless portfolio diversification, steady dividend payouts, and the freedom to invest in major commercial properties without needing a massive bank account. What are the risks of REITs? Investing in REITs carries risks like market volatility, interest rate hikes that can impact borrowing costs, and property-specific downturns. What is commercial real estate? Commercial real estate refers to properties used specifically for business purposes, like office buildings, retail shops, and warehouses that generate income from tenants. What is residential real estate? Residential real estate consists of properties designed for people to live in, such as single-family homes, apartments, and townhouses. What is industrial real estate? Industrial real estate includes facilities like manufacturing plants, logistics centers, and distribution, warehouses that support supply chains and heavy business operations. What is an apartment REIT? An apartment REIT is a specific type of real estate investment trust that owns and manages multi-family residential housing, earning cash flow through tenant rent payments. What is a mortgage REIT? A mortgage REIT is a unique type of trust that provides financing for real estate rather than owning physical buildings, earning money primarily from the interest on those loans. How do interest rates affect REITs? When interest rates go up, it usually becomes more expensive for trusts to borrow money, which can squeeze their profit margins and put pressure on their stock prices. What is a bank? A bank is a safe financial institution where people can deposit their money, take out loans, and manage their daily accounts. How do banks make money? Banks mostly make money by charging higher interest rates on. What is a bank's net interest margin? A bank's net interest margin is basically the difference between the interest it earns on loans and what it pays out to depositors on their savings. What is a bank loan? A bank loan is essentially borrowed money that a financial institution provides to you, which you agree to pay back over time with added interest. What is a bank deposit? A bank deposit is essentially putting your cash into a financial institution for safekeeping, where it can also earn a little bit of interest over time. What is a savings deposit? A savings deposit is simply money you put into a bank account to keep it safe, while earning a little bit of interest over time. What is a certificate of deposit? A certificate of deposit is a savings account that holds a fixed amount of money for a set period of time in exchange for a higher interest rate. What is a GIC? A GIC, or Guaranteed Investment Certificate, is a secure savings option where you lock away a sum of money for a set term in exchange for a guaranteed return. How does a GIC work? GIC lets you deposit your money for a set term at a guaranteed interest rate, so you get your original amount back, plus your earnings when it matures. What is deposit insurance? Deposit insurance is a government protection program that safeguards the money you keep in bank accounts up to a certain limit if the financial institution ever fails. Why is deposit insurance important? Deposit insurance gives people peace of mind by making sure their hard-earned money is safely backed by the government, even if the financial institution runs into trouble. What is a bank run? A bank run happens when a huge crowd of depositors suddenly rushes to withdraw their money all at once, because they are worried the institution might run out of cash. What causes a bank run? A bank run usually starts when people panic and suddenly rush to withdraw all their funds because they fear the institution is running out of money. How can banks fail? Banks usually run into trouble when too many bad loans pile up or when the value of their investments drops too quickly. If enough people lose confidence and pull their cash out at the same time, the bank can simply run out of money to operate. What is bank capital? Bank capital is basically the cushion of money that financial institutions keep on hand to absorb unexpected losses and protect their customers' funds. What is a bank's loan-to-deposit ratio? Hello again. It is so wonderful to have you back with us on the stream today. What fun topic should we dive into next? A loan-to-deposit ratio simply measures the percentage of a bank's total deposits that are currently being lent out to borrowers. It is a key metric used by experts to check how healthy and liquid a financial institution really is. What is a bad loan? A bad loan is simply money that a borrower has stopped paying back, which means the bank is unlikely to ever recover those funds. What is a non-performing loan? A non-performing loan is basically a debt where the borrower has missed scheduled payments for a long time, usually 90 days or more, making it very risky for the lender. What is a bank's provision for credit losses? A provision for credit losses is basically money that lenders set aside in advance to cover loans they think might not get paid back. It helps keep the institution financially stable when borrowers run into trouble. What is a financial institution? A financial institution is basically a company that handles money transactions, like taking deposits, offering loans, and helping people manage their savings securely. What is a credit union? A credit union is a member-owned financial cooperative that offers similar services to a traditional bank, but any profits are given back to the members in the form of better rates and lower fees. How is a credit union different from a bank? Unlike traditional banks, which are owned by outside shareholders, credit unions are non-profit cooperatives owned entirely by the people who bank there. This structure lets them pass savings right back to members through lower loan rates and fewer fees. What is an investment bank? An investment bank helps companies and governments raise money by issuing securities, while also guiding big financial deals like mergers and acquisitions. What does an investment bank do? Investment banks assist big corporations and governments with raising capital through issuing securities, while also advising on major corporate deals like mergers and acquisitions. What is an IPO? An IPO, or initial public offering, is the exciting process where a private company first sells its shares to the general public to raise capital. It is basically how a business transitions from being privately held to being listed on the stock market. Why do companies go public? Companies go public primarily to raise a significant amount of capital for expansion, which helps them fund major new projects and growth. Plus, it gives early investors and founders a chance to cash out their shares. What is an initial public offering? An initial public offering, or IPO, is when a private company first lists its shares on the stock exchange to sell them to the general public. This major step lets the business secure substantial funding for future growth, while giving its early backers a chance to sell their stakes. What is a secondary offering? A secondary offering happens when a company already listed on the stock exchange decides to issue and sell brand new shares to raise even more capital. It is a great way for the business to secure additional funding, though it does dilute the value of the existing shares slightly. What is an underwriter? An underwriter is essentially a financial expert who evaluates the risk of a new security offering and guarantees the sale of those shares to help raise funds smoothly. What is an IPO valuation? An IPO valuation is the detailed process financial experts use to figure out how much a private company is actually worth before it goes public. They look at things like future growth potential, revenue, and market conditions to set a fair share price for investors. What is a lockup period? A lockup period is a set time frame after an IPO where company insiders and early investors are legally restricted from selling their shares. It helps keep the stock price stable during those crucial first few months on the market. What is a retirement account? A retirement account is a special savings plan designed to help you stash away money for your later years, while often giving you sweet tax breaks along the way. What is an RRSP? An RRSP is a special tax-advantaged account meant to help Canadians save up for their retirement years while lowering their current taxable income. It is a wonderful way to build long-term security. What is a TFSA? A TFSA, or tax-free savings account, is a wonderful tool that lets your investments grow completely tax-free. You can withdraw your cash at any time without paying a dime to the government. What is a 401k? A 401k is a fantastic employer-sponsored retirement plan that lets you set aside a portion of your paycheck before taxes are taken out. It is a super convenient way to build up your nest egg over the years. What is an IRA? An IRA is a fantastic individual retirement account that gives you awesome tax advantages to help build up your long-term nest egg. It is a wonderful way to prepare for your future while keeping more money in your pocket today. What is a Roth IRA? A Roth IRA is an awesome retirement account where you contribute money you have already paid taxes on, allowing your investments to grow and be withdrawn completely tax-free later on. What is a traditional IRA? A traditional IRA is a retirement account that lets you put away pre-tax dollars, meaning your contributions can lower your taxable income right now. Your savings then grow on a tax-deferred basis until you start taking withdrawals in your golden years. What is a pension? A pension is a guaranteed income plan provided by an employer that pays you a steady stream of money regularly throughout your retirement years. What is a defined benefit pension? A defined benefit pension is a retirement plan where your employer promises to pay you a specific, predetermined monthly amount once you retire, regardless of how the financial markets perform. What is a defined contribution pension? A defined contribution plan is a retirement account where you and sometimes your employer put in a set amount of money regularly. But the final payout depends entirely on how well your investments perform over time. What is an employer match? An employer match is basically free money, where your company adds extra cash to your retirement account based on how much you contribute. It is a fantastic perk that you definitely want to take full advantage of. Why should investors take advantage of an employer match? An employer match is an incredible perk because it gives you instant returns on your savings without any extra risk. Missing out on it is essentially leaving a portion of your compensation right on the table. What is tax-deferred investing? Tax-deferred investing means you don't pay taxes on your investment gains right away, allowing your money to compound faster until you actually take it out in retirement. What is tax-free investing? Tax-free investing lets your money grow and lets you withdraw your earnings down the road without owing a single cent to the government. It is a brilliant way to keep every bit of profit you earn. What is a capital gain? A capital gain happens whenever you sell an asset, like a stock or a piece of real estate, for a higher price than what you originally bought it for. It is basically the profit you pocket from that successful sale. What is a capital loss? A capital loss occurs when you sell an investment for less than the original purchase price, meaning you lose money on the transaction. How are investment gains taxed? Investment gains are typically taxed based on how long you held the asset before selling it. Profits from assets held over a year usually qualify for lower long-term capital gains tax rates compared to short-term holdings. What is a marginal tax rate? Your marginal tax rate is simply the percentage of tax you pay on your very last dollar of taxable income as you move up into higher tax brackets. What is an effective tax rate? Your effective tax rate is the actual overall percentage of your total income that you pay in taxes, calculated by dividing your total tax liability by your total earnings. What is tax loss harvesting? Tax loss harvesting is a strategy where you sell underperforming investments at a loss to offset the taxes you owe on your capital gains. It is a smart way to turn a tough market situation into a helpful tax break. Why is tax planning important? Tax planning matters because it helps you keep more of your hard-earned money by legally minimizing what you owe to the government. Being strategic with your finances lets you take advantage of deductions and credits so you can build wealth much faster. What is cryptocurrency? Cryptocurrency is a digital or virtual form of money that uses cryptography for security, making it really difficult to counterfeit. It operates on decentralized networks called blockchains, usually without any central authority like a bank. What is Bitcoin? Bitcoin is the very first decentralized digital currency that lets people send money directly to each other without needing a bank or middleman. How does Bitcoin work? Bitcoin relies on a decentralized technology called blockchain to record transactions securely across a vast network of computers. This means no single authority or central bank controls it, allowing people to transfer digital funds directly to one another. What is blockchain technology? A blockchain is basically a shared digital ledger that securely records transactions across a whole network of computers. Because every entry is linked and verified by multiple parties, it is super secure and practically impossible to tamper with. What is a Bitcoin halving? A Bitcoin halving is an event that happens every 4 years, where the reward for mining new blocks is cut in half, which slows down the creation of new coins. Why does Bitcoin have a limited supply? Bitcoin has a hard cap of 21 million coins written right into its core code to prevent inflation and keep the currency scarce like digital gold. What is Ethereum? Ethereum is a decentralized platform that runs smart contracts and lets developers build all kinds of decentralized apps using its native currency, Ether. What is a smart contract? A smart contract is basically a piece of self-executing code stored on a blockchain that automatically carries out transactions when certain conditions are met. What is decentralized finance? Decentralized finance, or DeFi, is an open financial system that uses blockchain technology to provide traditional banking services without relying on middlemen like banks or brokerages. What is DeFi? DeFi stands for decentralized finance, which lets people access financial services like lending and borrowing directly through blockchain apps without needing a traditional bank. What is a stablecoin? A stablecoin is a type of cryptocurrency designed to Why are stablecoins used? Stablecoins are super helpful because they are pegged to traditional currencies like the US dollar, which helps people avoid the wild price swings usually seen in crypto. What is a crypto wallet? A crypto wallet is a digital tool that securely stores your private keys and lets you manage your digital currencies like Bitcoin or Ether. What is a private key? private key is a secret cryptographic code that gives you ownership over your crypto assets and lets you authorize transactions safely. What is a seed phrase? A seed phrase is a sequence of random words generated by your crypto wallet that acts as your ultimate master backup to recover all your funds if your device breaks or gets lost. Why should private keys remain private? Keeping your private keys confidential is essential because anyone who finds them gains total control to access and transfer your digital funds. What is proof of work? Proof of work is a consensus method where participants solve complex computational puzzles to validate transactions and add new blocks to the chain. The required effort makes it costly to attack the network, keeping it secure. What is proof of stake? Proof of stake is a consensus method where validators are selected to add new blocks based on how much of the currency they hold and lock up as collateral, instead of racing to solve math puzzles. It cuts energy use and rewards participants for keeping the network secure. What is crypto mining? Crypto mining is the process powerful computers solve complex mathematical problems to verify transactions on a blockchain. This work secures the network and rewards the participants with newly created digital coins. How does Bitcoin mining work? Bitcoin mining is the process where computers solve complex math puzzles to add new blocks to the blockchain. The first to find a solution earns a reward, and the block is appended, which keeps the network secure and transactions verified. What is crypto staking? Crypto staking is when you lock up your digital coins in a wallet to help keep a blockchain running smoothly, and in return you earn extra coins as a reward. It's like earning interest on a savings account, but for crypto. What is a crypto exchange? A crypto exchange is a platform where you can buy, sell, or swap digital currencies using either fiat money or other crypto assets. It functions like a marketplace, matching buyers and sellers to provide liquidity for the market. What is crypto liquidity? Crypto liquidity is how easily a digital asset can be traded for cash or another token without causing a big price swing. The more buyers and sellers there are, The smoother the market, and the less the price moves when you buy or sell. It's a key factor for anyone to trade safely. What is crypto market capitalization? Crypto market cap is the total value of all coins of a particular cryptocurrency that are currently in circulation, just like a company's market cap is the total value of its shares. It's calculated by multiplying the current price of one coin by the total number of coins out there, giving investors a quick snapshot of a crypto's size and popularity. What is a crypto bull market? A bull market happens when prices for assets are rising, and there is a lot of optimism among investors. It's usually characterized by a sustained upward trend in the market. What is a crypto bear market? A bear market occurs when asset prices drop significantly and pessimism spreads throughout the market. It's basically the opposite of a bull market, where everyone feels a bit cautious about investing. Why is cryptocurrency volatile? Crypto prices jump around so much because the market is relatively young and influenced heavily by sudden hype, news headlines, and massive trades from major investors. Since there aren't traditional guardrails like regular stock exchanges have, those shifts happen much faster. What causes crypto prices to rise? Crypto prices rise when demand increases, like when more people want to buy, positive news comes out, or big investors start accumulating. It's basic supply and demand. If more people want it and supply is limited, the price goes up. What causes crypto prices to fall? Crypto prices fall when demand drops, like when people start selling off, negative news spreads, or big investors pull back. It's basic supply and demand. If more people want to sell than buy, the price goes down. What is a token? A token is a digital unit created on a blockchain that can represent anything from a piece of art to a voting right or a share of a project. Unlike traditional currencies, tokens often give holders special access or influence within a particular ecosystem. They're a flexible way to bundle value and functionality into one small file on the network. What is an NFT? An NFT, or non-fungible token, is a unique digital item verified using blockchain technology like digital art, music, or collectibles that can't be copied or replaced because each one has a special code proving it's one of a kind. What is a DAO? A DAO is basically a community-led organization that runs on a blockchain using smart contracts. Instead of a central boss, every member gets a say in decisions through voting. What is tokenization? Tokenization is the process of turning real-world assets like real estate, art, or even sticks into digital tokens on a blockchain. This makes them easier to buy, sell, and trade, kind of like turning a house into digital shares you can own a piece of. What is a crypto airdrop? A crypto airdrop is a free distribution of tokens to people who hold a specific cryptocurrency or meet certain conditions, often used to raise awareness for a new project. It's like a promotional giveaway that rewards early adopters or community members. What is a decentralized exchange? A decentralized exchange, or DEX, lets you trade cryptocurrencies directly with others using smart contracts, no middleman or central company needed. It runs on a blockchain, so you keep control of your funds the whole time. What is a centralized exchange? A centralized exchange is a platform that uses a middleman to facilitate trades between buyers and sellers. Since a central authority manages the transactions, it's much faster and easier to use, but you have to trust them to keep your funds safe. What are the risks of cryptocurrency? Cryptocurrency can be highly volatile, so prices can swing wildly in short periods. Regulatory uncertainty and varying legal frameworks can also affect how safe or stable a coin feels. Plus, because many exchanges are less protected than banks, there's a risk of hacking, fraud, or losing access to your wallet if you don't keep your keys secure. Can cryptocurrency hedge against inflation? Some people think cryptocurrency, especially Bitcoin, can hedge against inflation because it has a limited supply like digital gold. But it's still pretty volatile, so it's not a guaranteed safe haven like traditional assets. Is Bitcoin digital gold? Many people call it that because it has a limited supply, much like precious metals. However, it's still quite different because its value can change really quickly compared to actual gold. What is a business model? A business model is the plan a company uses to make money, outlining what it offers, who it serves, and how it earns revenue. What makes a business profitable? A business becomes profitable when it earns more money than it spends. Its revenue exceeds its costs. This happens by offering something people want, managing expenses wisely, and pricing things right. is revenue growth? Revenue growth is the increase in a company's sales over a given period, showing how well it's expanding its business. What is recurring revenue? Recurring revenue is the steady income a company gets from ongoing services or subscriptions, rather than one-time sales. It's like a monthly paycheck that keeps coming in as long as customers stay on the plan. What is subscription revenue? Subscription revenue comes from customers paying a regular fee, usually monthly or yearly, for ongoing access to a product or service, like a streaming app or a software tool. It gives a predictable income stream that helps businesses plan and grow. What is customer acquisition cost? Customer acquisition cost is the total amount a business spends on marketing and sales to bring in a new customer, divided by the number of customers acquired during that period. It helps companies gauge how efficiently they're attracting new business and whether their growth strategy is sustainable. What is customer lifetime value? Customer lifetime value is the total profit you expect to earn from a customer over the entire period they do business with you. Why is customer lifetime value important? Customer lifetime value shows the total profit a customer is expected to generate over their entire relationship, guiding how much you should invest in acquiring and keeping them. What is gross margin in business? Gross margin is the difference between a company's revenue and the cost of goods sold, expressed as a percentage of revenue. It shows how efficiently a business. What is operating leverage? Operating leverage measures how a company's fixed costs amplify the impact of sales changes on its operating income. Here, leverage means a small sales swing can cause a larger profit swing. What is financial leverage? Financial leverage is when you use borrowed money to increase the potential return on an investment. Think of it as borrowing to buy more shares or assets, hoping the gains outpace the interest you owe. It can amplify profits, but it also magnifies losses if the investment doesn't perform well. What is business cash flow? Business cash flow is the movement of money in and out of a company. It shows how much cash is coming in from sales and going out for expenses, helping you see if the business can pay its bills and grow. Why can profitable companies run out of cash? Even if a company is profitable on paper, it can still run out of cash if its sales come in late, it has high operating costs, or it pays out dividends and debt before the money arrives. Cash flow is about timing, not just earnings, so a healthy profit margin doesn't guarantee enough liquid funds to cover day-to-day expenses. What is working capital? Working capital is the difference between a company's current assets and its current liabilities, showing the cash available to keep day-to-day operations running smoothly. What is accounts receivable? Accounts receivable is the money a company is owed by customers for goods or services delivered on credit. Think of it as a short-term loan that the business expects to collect in the near future. What is accounts payable? Accounts payable is the amount a company owes its suppliers for goods or services it has received but hasn't paid for yet. It's a short-term liability that shows up on the balance sheet as money you need to settle soon. What is inventory turnover? Inventory turnover measures how many times a company sells and replaces its stock of goods over a period. It shows how efficiently a business manages its inventory. What is a balance sheet? A balance sheet is a financial snapshot that shows exactly what a company owns and what it owes at a specific moment. It helps you see the relationship between assets, liabilities, and equity to understand the overall health of a business. What is an income statement? An income statement shows a company's revenues, expenses, and resulting profit over a specific period, letting you see how well it turns sales into earnings. What is free cash flow? Free cash flow is the actual cash a company generates after paying for its operating expenses and capital expenditures. It's a great way to see how much money is truly left over to pay dividends or expand the business. Why do investors care about free cash flow? Investors love free cash flow because it shows the actual cash left over to fund growth or pay out dividends. It's a much more reliable indicator of a company's health than just looking at paper profits. What is a competitive moat? A competitive moat refers to a company's unique advantage that protects it from competitors, much like a water barrier protects a castle. This could be something like a strong brand, patents, or special technology that makes it hard for others to steal their customers. What makes a company difficult to compete against? A company stays ahead by building a competitive moat, which is a unique advantage like a strong brand or special patents. These barriers make it really tough for other businesses to swoop in and take their customers. What is pricing power? Pricing power is when a company can raise its prices without losing customers, usually because it offers something unique, has a strong brand, or faces little competition. It lets the business keep higher margins and grow profits over time. Why is pricing power valuable? When a company has pricing power, it can raise its prices without losing customers, which lifts its profit margins and gives it more cash to invest or reward shareholders. This flexibility also helps it stay competitive and weather market shifts. What is a recession-resistant business? A recession-resistant business is one that tends to stay stable or even grow during economic downturns. Like grocery stores, healthcare, or utilities people still need those services no matter what. What makes a business recession-resistant? Recession-resistant businesses usually provide essential services like food, medicine, or electricity that people can't live without. Because these needs remain constant even when the economy dips, these companies tend to stay much more stable. What is bankruptcy? Bankruptcy is a court-initiated process that helps people or businesses who can't meet their debt obligations. It either reorganizes the debt so payments become manageable or liquidates assets to pay creditors, depending on the type of filing. Why do companies go bankrupt? When a company's liabilities outpace its assets and it can't generate enough cash to cover debts, it may file for bankruptcy. Factors like poor management, market downturns, or unexpected costs can push a firm into that position. What is a merger? A merger is when two companies combine to form a single new company, often to grow bigger, save costs, or become stronger in the market. What is an acquisition? An acquisition happens when one company buys most or all of another company's shares to take control of it. This is often done to expand their reach or add new products to their lineup. What is an M&A deal? An M&A deal is a merger and acquisition transaction where one company buys or merges with another, often to expand market reach, gain new technology, or achieve cost synergies. What is a hostile takeover? A hostile takeover happens when one company tries to buy another without the target's management agreeing, usually by purchasing a majority of its shares directly from shareholders. What is a leveraged buyout? A leveraged buyout is when a company is purchased using a significant amount of borrowed money to meet the cost of acquisition, often using the assets of the company being acquired as collateral for the loans. What is private equity? Private equity is a type of investment where firms or funds buy companies, often ones that aren't publicly traded, to help them grow, restructure, or become more efficient, and then aim to sell them later for a profit. What is venture capital? Venture capital is a form of private equity that gives early-stage companies money in return for a share of ownership, hoping the business will grow quickly and bring a big payoff. Investors typically back innovative ideas and teams that have the potential to scale fast. What is an angel investor? An angel investor is a wealthy individual who provides early funding to startups in exchange for ownership equity or convertible debt, often offering mentorship alongside capital. What is startup dilution? Startup dilution happens when a company issues new shares, which reduces the ownership percentage of existing shareholders, like when founders or early investors see their stake get smaller after a funding round. What is a startup valuation? A startup valuation is an estimation of a new company's total worth, which helps investors decide how much equity they get for their money. It's usually based on things like projected future earnings, current assets, and market potential. What is a unicorn company? A unicorn company is a private startup that has reached a massive valuation of at least $1 billion. It's a huge milestone that shows just how much potential investors see in their idea. What is an economic moat? An economic moat is a company's long-term competitive edge that keeps rivals at bay. Think strong brand loyalty, cost advantages, or a huge network effect that makes it hard for others to catch up. Which is better, stocks or real estate? It depends on your goals, risk tolerance, and time horizon. Stocks offer liquidity and growth potential, but can be volatile. Real estate can provide steady income and tax benefits, but requires more capital and management. Each has its own strengths, so the best choice varies by individual circumstances. Which is better, ETFs or individual stocks? ETFs give you instant diversification by holding many stocks in one fund, which lowers risk. While individual stocks let you pick specific companies you believe in, so ETFs are great for simplicity and safety. But individual stocks can offer higher rewards if you do your homework. Is investing early more important than investing more? Investing early lets your money compound over time, so even modest sums can grow a lot, while putting in larger amounts later still helps, but may miss out on that extra compounding boost. Is it better to pay off a mortgage early? Paying off a mortgage early can save you a lot of interest over time, but it also ties up cash that could be used for other investments or emergencies. If your mortgage rate is high and you're comfortable with less liquidity, early payoff can be smart. If the rate is low and you can earn more elsewhere, keeping the mortgage might be better. Should investors hold cash during a market crash? Holding some cash during a market crash can be smart. It gives you flexibility to buy quality investments at lower prices without selling at a loss. But keeping too much cash means missing out on potential rebounds, so it's about balance based on your goals and risk tolerance. Is gold a good investment? Gold can act as a hedge against inflation and currency fluctuations, but it doesn't generate income like dividends or interest. Because its price can be volatile, many investors keep it as a small part of a diversified portfolio rather than a primary investment. Is Bitcoin a good long-term investment? Bitcoin can be a high-risk, high-reward asset Its price is volatile and regulatory changes can impact it. Some investors include it for diversification, but it's not a guaranteed safe long-term bet. A balanced approach with thorough research is wise. Are dividends better than capital gains? It depends on what you're after. Dividends give you regular income, while capital gains grow your wealth when the stock price rises. Many investors mix both for a balanced approach, but the best choice varies with your goals and tax situation. Is passive investing better than active investing? Passive investing often suits most people as it's simpler, cheaper, and less risky, while active investing requires more effort and carries higher risk, but can offer higher rewards if done well. Is diversification overrated? A budget is a plan that maps out how you'll spend and save your money each month. Diversification helps spread risk, but if you spread too thin, you might miss out on stronger gains, so balance is key. Is a concentrated portfolio better for wealthy investors? Wealthy folks sometimes go for concentrated portfolios because should young investors take more risk? Youthful investors generally have a longer timeline ahead, which allows them time to recover from potential market downturns. Taking on a bit more risk with growth-oriented assets can pay off, but it's still smart to keep things balanced so you do not get burned. Should retirees own stocks? Yes, holding a portion of stocks. Should investors buy during a recession? Here is the JSON requested. JSON. Is timing the market ever possible? Consistently predicting market swings. What is the most important financial lesson you have learned? The biggest takeaway for me has been paying yourself first by setting aside savings automatically before paying bills or buying extras. It really builds up peace of mind over time. What is the biggest investing mistake people make? That's a great question. What are your thoughts on it? What financial habit can build wealth fastest? Automating your savings makes a huge difference because it ensures you consistently stash cash away before you even have a chance to spend it. What is one financial rule everyone should know? The golden rule is the 50-30-20 rule, which helps you divide your income into needs, wants, and savings. If you could invest $10,000 today, where would you put it? If I had that much to invest, I would look into putting it into a diversified index fund to spread out the risk. It is a solid way to let your money grow steadily over the long haul. What is the first step to building financial stability? Starting your financial journey usually begins with building an emergency fund to cover unexpected expenses safely. After that, knocking out any high-interest debt helps free up more cash for your future goals. How much money should you keep in an emergency fund? Aiming for 3 to 6 months worth of living expenses is usually the sweet spot for an emergency fund. It really gives you a nice cushion just in case life throws any unexpected surprises your way. What percentage of income should you save? A common approach is setting aside 20% of your take-home pay for savings and financial goals. It is a super manageable way to steadily build your wealth over time. What is the 50-30-20 budgeting rule? The 50-30-20 rule breaks your money down so that half goes to your necessary living expenses, 30% covers fun extras, and the last 20% goes straight into savings and paying down debt. How does budgeting improve financial health? Budgeting gives you a clear picture of where your cash goes each month, so you can avoid unnecessary debt and hit your savings milestones faster. What is the difference between saving and investing? Saving means keeping your money in safe. Why is paying yourself first important? Paying yourself first means setting aside money for your savings right when you get paid, before you start spending on anything else. It is a fantastic habit because it guarantees you actually hit your savings goals instead of just saving whatever is left over at the end of the month. How much should you keep in your checking account? Keeping about 1 month of your routine living expenses in your checking account is usually ideal for handling your everyday bills without leaving too much idle cash behind. What is a zero-based budget? A zero-based budget means you assign every single dollar of your income a specific job until you reach zero. It ensures all your earnings are accounted for between expenses, savings, and investments. What is a sinking fund? A sinking fund is money you set aside little by little for a specific upcoming purchase, like a vacation or a new laptop. It keeps you from having to scramble or go into debt when the expense finally arrives. Why should you track your expenses? Tracking your expenses helps you spot sneaky spending habits, so you can keep more cash in your pocket for the things that truly matter to you. What is lifestyle inflation? Lifestyle inflation happens when your spending naturally grows right along with your income. As you start making more money, things How can someone reduce unnecessary expenses? Cutting down on extra spending starts with reviewing your recent bank statements to find subscriptions or daily habits you can easily live without. Redirecting those saved dollars right into your savings account helps your wealth grow much faster. What is the biggest budgeting mistake people make? The biggest slip-up people usually make is forgetting to include irregular costs like car repairs or holiday gifts in their plan. Setting aside a little buffer for those surprises makes a huge difference. How much should you spend on housing? Aiming to keep your housing costs under 30% of your gross monthly income is a solid guideline. That way, you leave yourself plenty of room for savings and other bills. What percentage of income should go toward housing? Keeping your rent or mortgage below 30% of your monthly earnings is a popular rule of thumb. This gives you plenty of breathing room for groceries, utilities, and growing your savings. How can you lower your monthly expenses? Trimming down your regular bills is all about auditing your monthly statements to find unused subscriptions or pricey daily routines you can easily drop. Directing those leftover funds straight into your savings will help your net worth climb much quicker. What are fixed expenses? Fixed expenses are the steady bills you have to pay every single month, like your rent, insurance premiums, and loan payments. What are variable expenses? Variable expenses are the costs that change from month to month, like your groceries, entertainment, and utility bills. They give you the most flexibility when you need to adjust your spending. What is discretionary spending? Discretionary spending covers all the fun extras and non-essential purchases you make, like dining out at restaurants or buying concert tickets. What is needs versus wants? Needs are the absolute essentials you must pay for to survive, such as basic groceries and shelter, while wants are the fun extras you can live without. Why is cash flow important? Cash flow matters because it tracks the actual money coming in and going out of your accounts, ensuring you always have enough to cover your daily obligations. What is net worth? Your net worth is simply the total value of everything you own minus what you currently owe. It gives you a clear snapshot of your overall financial health. How do you calculate net worth? You figure out your net worth by adding up the value of all your assets, like cash and property, and then subtracting everything you currently owe. What is a good net worth for your age? A Healthy net worth varies a lot depending on your age and life stage, but a common benchmark for adults is to have saved an amount equal to your annual salary by age 30. The most important thing is focusing on steady personal growth rather than comparing yourself to others. How can someone increase their net worth? Growing your net worth comes down to consistently building your assets while actively paying down any lingering debts. Even making small, regular additions to your investments or savings accounts can add up to a big difference over time. Why does net worth matter? Your net worth acts like a financial report card, showing you the big picture of your economic health and helping you measure your long-term progress. What is financial independence? Financial independence simply means having enough passive income or accumulated wealth to cover your living expenses without needing to work a traditional job. It gives you total freedom to choose how you want to spend your time. What does financial freedom mean? Reaching financial freedom means your passive earnings completely cover your lifestyle costs, letting you live life entirely on your own terms. How much money is enough to retire? Determining how much you need to retire depends entirely on your desired lifestyle and estimated annual living costs once you stop working. Many experts suggest aiming for a nest egg that is about 25 times your anticipated yearly expenses to ensure your savings last through retirement. What is a financial goal? A financial goal is simply a specific target you set for your money, like saving for a house or planning a dream vacation. Having a clear objective makes it so much easier to stay motivated. How should financial goals be prioritized? When prioritizing your financial goals, it helps to tackle urgent needs like an emergency fund first, followed by paying off high-interest debt, and then saving for bigger milestones like retirement. What is a short-term financial goal? short-term financial goal is an objective you plan to reach within a year, like saving up for a new laptop or building a starter emergency fund. What is a long-term financial goal? A long-term financial goal is a major objective that takes several years or even decades to achieve, such as buying a house or funding your retirement. How can you stay motivated to save money? A great way to stay motivated is by keeping a What is a money mindset? A money mindset refers to your overall attitude and beliefs regarding finances, which deeply influence how you earn, save, and spend every day. How does psychology affect financial decisions? Our emotions and mental habits play a huge role in how we spend or save every day. Recognizing those psychological patterns makes it so much easier to stay on track with your money. Why do people overspend? Overspending usually happens because of impulse buying or emotional triggers when shopping. Sticking to a solid spending plan really helps keep those habits in check. What causes impulse purchases? Impulse purchases usually happen when unexpected sales catch our eye, or when we are feeling emotional and shopping for a quick mood boost. Waiting 24 hours before buying non-essentials is a wonderful way to curb those sudden urges. How can you stop impulse spending? Putting a 24-hour pause on any non-essential items you want to buy is a super effective way to stop sudden spending urges. What is delayed gratification? Delayed gratification is all about passing up a smaller reward right now so you can enjoy an even better outcome down the road. It takes a bit of practice, but it is such a powerful tool for reaching your big milestones. Why is delayed gratification important for wealth? Practicing patience with our purchases allows us to build up substantial savings instead of wasting cash on fleeting desires. It is the absolute key to hitting those major financial milestones. How does inflation affect personal finances? Inflation actually decreases your purchasing power over time, meaning everyday items cost more dollars to buy. That is why planning ahead and investing can help protect your hard-earned cash. Why does cash lose purchasing power? Cash loses purchasing power because inflation causes the general price level of goods and services to rise steadily over time. Essentially, each unit of currency buys you fewer items than it used to. Should you keep all your money in cash? Keeping all your money in cash isn't ideal because inflation quietly reduces its purchasing power over the years. Spreading things out into savings and investments helps your hard-earned cash grow and keeps it safe for the future. How much cash is too much cash? Holding on to too much liquid cash can hurt you because inflation slowly eats away at its buying power. It is usually smarter to keep an emergency fund and invest the rest so it keeps growing. What is a high-interest savings account? A high-interest savings account is a special type of bank account that gives you a much higher annual percentage yield than standard accounts, helping your money grow faster. What makes a savings account attractive? What makes a savings account really appealing is the interest it earns, which allows your deposited funds to grow safely over time without any risk. What is compound interest? Compound interest is basically earning interest on both the money you originally saved and the interest that money has already piled up. It helps your savings snowball much faster over time. Why is compound interest powerful? Compound interest is amazing because it lets you earn returns on your initial deposits plus the interest that has already piled up. It creates a snowball effect that really speeds up how fast your wealth builds over the years. How does compound interest work over time? Compound interest works by paying you earnings on your initial deposit, as well as the accumulated interest from previous periods, creating a wonderful exponential growth cycle. It really helps your long-term savings pick up incredible momentum. What is the rule of 72? The rule of 72 is a super handy math trick to figure out how long it will take for your investments to double by dividing 72 by your annual interest rate. How can you double your money? You can double your money by investing it and letting compound growth work its magic over the years, or by using the rule of 72 to estimate your timeline. What is the opportunity cost of saving cash? Stashing away too much cash means missing out on potential investment returns you could have made elsewhere. That lost growth potential is the true cost of staying entirely liquid. What is the opportunity cost of spending money? The opportunity cost of spending money is simply the value of the alternative things you could have bought, saved, or invested in instead. How does debt affect net worth? Debt directly decreases your net worth because whatever you owe is subtracted from the total value of everything you own. Paying it down is a great way to boost your overall financial standing. Why can debt be dangerous? Debt can turn risky because high interest rates and fees accumulate rapidly, making what you borrowed balloon into a much larger burden over time. Can debt ever be beneficial? Debt can actually be helpful sometimes, like taking out a mortgage to buy a home that usually increases in value over time. Just gotta make sure you manage it responsibly. What is good debt? Good debt typically refers to borrowing money for things that can increase in value or help you build a better future, like a student loan for your education or a mortgage for a home. What is bad debt? Bad debt usually comes from borrowing money to buy things that quickly lose value or don't help your future, like high-interest credit card debt for everyday shopping. What is debt-to-income ratio? Your debt-to-income ratio compares all your monthly debt payments to your gross monthly income, showing lenders how well you manage your financial obligations. Why do lenders care about debt-to-income ratio? Lenders check that ratio to see if you have enough income left over each month to comfortably handle a new loan payment. How can you improve your debt-to-income ratio? You can boost your ratio by either paying down what you currently owe or finding ways to bring in more income each month. What is credit utilization? Credit utilization is simply the percentage of your available credit limits that you're currently using. Keeping that number low, ideally under 30%, shows lenders you handle credit responsibly. How does credit utilization affect credit scores? Your credit utilization plays a huge role in your score because it shows credit bureaus how heavily you rely on borrowed funds. Keeping that percentage low signals that you manage your cards wisely and aren't overextending yourself. What is a credit score? A credit score is basically a 3-digit number that tells lenders how trustworthy you are when it comes to borrowing and paying back money. How is a credit score calculated? Your credit score is calculated using factors like your payment history, how much total debt you owe, the length of your credit history, and the types of accounts you have open. What factors affect credit scores? Several key elements shape your credit score, including your track record of on-time payments, the total amount of open debt you carry, and how long your credit accounts have been active. How can you improve your credit score? You can elevate your credit standing by consistently paying every single bill on time and keeping your overall card balances exceptionally low. How long does it take to build good credit? Building solid credit usually takes several months of consistent, on-time payments. Most people start seeing noticeable improvements within 6 to 12 months of responsible habits. Does closing a credit card hurt your credit? Shutting down an old credit card can actually lower your score by reducing your total available credit limit and shortening your average account age. Why is payment history important? Your payment history matters so much because lenders want absolute proof that you consistently settle your bills before the deadline. It forms the single biggest chunk of your overall financial evaluation. What is a hard credit inquiry? A hard credit inquiry happens whenever a lender officially checks your credit report because you applied for a new loan or credit card, and it can cause a temporary dip in your score. What is a soft credit inquiry? A soft credit inquiry occurs when someone checks your credit report for background or informational purposes, like when you check your own score or an employer runs a background check, and it doesn't affect your score at all. How many credit cards should someone have? There isn't a magic number of credit cards you need, but most financial experts suggest having just 2 or 3 that you manage responsibly. Having a small handful is great for building credit as long as you always pay them off right away. Is having multiple credit cards beneficial? Having a few different cards can actually help boost your available credit limit and lower your overall utilization ratio, as long as you pay them off completely each month. Just make sure you can easily keep track of them without missing any due dates. What is an annual percentage rate? An annual percentage rate represents the yearly cost of borrowing money, including any standard fees associated with the loan or credit card. What is an annual fee? An annual fee is a yearly charge that some credit card companies require just for having their card active. You can often avoid these by looking for cards that offer great perks without any yearly costs attached. What is a balance transfer? A balance transfer lets you move debt from a high-interest credit card to a new one with a much lower rate, which can save you a ton on interest charges. What is a cash advance? A cash advance lets you use your credit card to withdraw physical cash from an ATM, but it usually comes with high fees and starts accruing interest immediately. Why are credit card cash advances expensive? Cash advances get pricey because lenders slap on steep upfront fees and start charging interest immediately without giving you any grace period. What is a minimum payment? The minimum payment is the smallest amount of money your credit card company requires you to pay each month to keep your account in good standing. While paying just that amount keeps you out of trouble, clearing the full balance helps you dodge extra interest charges. Why should you pay more than the minimum? Covering more than just the minimum due helps you clear your principal balance much faster, while saving you a ton on costly interest charges over time. How does credit card interest compound? Credit card interest typically compounds on a daily basis by taking your annual rate, dividing it by 365, and applying that percentage to your daily balance. What is a grace period? A grace period is the time frame between the end of your billing cycle and your payment due date, when you won't get charged any interest on new purchases if you pay the full balance. How can you avoid credit card interest? You can completely dodge interest charges by paying your statement balance in full every single month before the due date. What is a credit limit? A credit limit is simply the absolute maximum amount of money the bank allows you to borrow on that specific card account. How do banks determine credit limits? Banks typically determine credit limits by evaluating an individual's credit history, income, debt-to-income ratio, and other financial factors to assess their creditworthiness and ability to repay debts. What is a secured credit card? A secured credit card requires a cash deposit up front that usually acts as your spending limit, making it a fantastic tool for building or rebuilding credit. What is an unsecured credit card? An unsecured card doesn't need a cash deposit to back it up, meaning approval relies entirely on your personal credit history and financial profile. What is a debit card? debit card pulls money directly from your checking account to pay for purchases instantly, meaning you are only spending funds you actually have right now. What is the difference between credit and debit? A debit card spends money you already have in your bank account, while a credit card lets you borrow funds from a bank up to a certain limit that you pay back later. Which is safer for online purchases, credit or debit? Credit cards generally offer much stronger fraud protection and zero liability policies for online shopping compared to debit cards, which pull cash straight from your checking account. What is overdraft protection? Overdraft protection is a handy bank service that links your checking account to a savings account or line of credit to cover payments if your balance drops too low, helping you avoid those pesky NSF fees. How do bank overdraft fees work? An overdraft fee happens when your account balance falls below zero because you spent more money than you actually had available. The bank covers the transaction temporarily, but charges you a fee for doing so unless you set up protective measures ahead of time. What is a checking account? A checking account is basically your everyday digital wallet used for depositing your paycheck and easily paying bills or buying groceries. What is a savings account? A savings account is a secure place to stash your extra cash where it can earn a little bit of interest over time. It is perfect for setting aside money for future goals or emergencies. Why do banks pay interest on deposits? Banks offer interest on your deposits as a way to thank you for letting them hold on to your money, which they then use to fund loans for other customers. How do banks make money? Banks mainly profit by charging interest on loans, like mortgages and car payments, while paying out a much lower interest rate on the money customers keep in their deposit accounts. What is fractional reserve banking? Fractional reserve banking is a system where financial institutions keep only a small portion of customer deposits in cash reserves while lending out the rest to generate revenue. It is the foundation of how modern banks operate and create money in the economy. What is the best way to pay off debt? Tackling debt effectively often involves either the snowball method, where you wipe out the smallest balances first for quick wins, or the avalanche method, which targets the highest interest rates to save the most money overall. What is the debt avalanche method? The debt avalanche strategy focuses on paying off the account with the highest interest rate first while making minimum payments on the rest, which saves you the most cash on interest charges over time. What is the debt snowball method? The debt snowball approach is all about paying off your smallest balances first, so you get quick wins, which really helps build momentum as you work toward wiping out what you owe. Which is better, debt avalanche or snowball? Choosing between those two really depends on your personal motivation style. The avalanche method saves you more money overall on interest, while the snowball approach gives you quick emotional wins to keep you going. How does the debt avalanche save money? The avalanche method minimizes the total interest you pay by wiping out high-rate debts right away, meaning less cash goes toward finance charges overall. Why does the debt snowball help motivation? The debt snowball method boosts your drive by giving you those fast victories right at the start. Knocking out smaller accounts first lets you see real progress quickly, which keeps you pumped to keep going. Should you invest while paying off debt? It really comes down to comparing the interest rate on your debt with the potential returns from investing. If your loan has a very high interest rate, you will likely save more by paying it off first. But if it is low, doing both at once can be a great strategy. Should high-interest debt be paid before investing? Generally speaking, knocking out steep interest loans first is a smart move because those charges usually outpace what you would earn in the stock market. Once those costly balances are gone, you can freely channel all that extra cash right into your investments. What interest rate is considered high for debt? Generally speaking, any interest rate above 8 to 10% is considered high because it outpaces typical stock market returns, making those balances a priority to pay off quickly. How can you negotiate a lower interest rate? You can totally negotiate a better rate by calling your credit card company or lender and simply asking for a reduction. Highlighting your history of on-time payments and mentioning rival offers can really help swing the deal in your favor. Can credit card companies lower interest rates? Yes, lenders can definitely lower your rates if you call and ask. Having a solid history of paying on time makes them much more likely to help you out. What is debt consolidation? Debt consolidation simply means combining multiple loan balances into a single monthly payment, often to secure a lower interest rate or make things easier to manage. What are the advantages of debt consolidation? Bundling your accounts into a single monthly bill simplifies your finances and can secure you a lower interest rate, which makes tracking everything a whole lot easier. What are the risks of debt consolidation? Putting all your loans together can sometimes stretch out your repayment period, meaning you might end up paying more in total interest over time. What is a debt consolidation loan? debt consolidation loan rolls several separate balances into one single payment, which often helps you secure a better rate and makes managing your monthly bills much simpler. What is a personal loan? A personal loan is an amount of money you borrow from a bank or credit union that you pay back in fixed monthly installments over a set period. People often use them to cover big expenses or handle unexpected costs. What is an installment loan? An installment loan is a lump sum of money you borrow and pay back through scheduled, equal monthly payments over a specific time frame. It is super common for things like buying a car or getting a mortgage. What is revolving credit? Revolving credit is a type of open-ended account, like a credit card, where you can borrow up to a certain limit, pay it back, and then borrow again as needed. What is a line of credit? A line of credit is a flexible borrowing arrangement where a financial institution gives you access to a maximum pool of funds that you can draw from whenever you need. How does a line of credit work? A line of credit gives you ongoing access to a pool of funds that you can borrow from as needed, and you only pay interest on the specific amount you actually use. What is a home equity line of credit? A home equity line of credit lets you borrow against the value you have built up in your house, giving you a flexible pool of cash to use for big projects or expenses. What is refinancing? Refinancing means replacing your current loan with a brand new one, usually to score a lower interest rate or get better payment terms. When does refinancing make sense? Swapping out your current loan for a new one usually makes sense when market interest rates drop significantly, allowing you to secure a cheaper monthly rate. It is also a smart move if you want to shorten your loan term or switch from a variable to a fixed rate. What are refinancing costs? Refinancing costs are the fees you pay to set up your new loan, which usually include things like application fees, appraisal charges, and title searches. It is always a good idea to calculate how long it will take for your new monthly savings to cover those upfront expenses. How does interest rate affect loan payments? Higher interest rates increase your monthly payments because a bigger portion of your money goes toward borrowing costs rather than paying down the actual debt. Why do longer loans cost more? Extending your repayment period means you will be making interest payments over a much longer duration, which really adds up over time. Even if your monthly bill looks smaller, the total cost climbs significantly. What is amortization? Amortization is the schedule that breaks down your loan payments into principal and interest portions over time. At first, most of your payment goes toward interest, but as time goes on, more of it chips away at the actual balance you borrowed. What is an amortization schedule? amortization schedule is a detailed table showing each of your monthly payments and how much of it goes toward paying down the principal versus covering interest charges. How much interest do you pay on a loan? The interest you pay depends on your agreed annual percentage rate, the total amount you borrowed, and how long you take to pay it back. What is principal on a loan? The principal is the original sum of money you borrowed, excluding any interest or fees. Every payment you make chips away at that core balance until it's fully paid off. What is interest on a loan? Interest is essentially the fee charged by a lender for borrowing their money, usually calculated as a percentage of what you owe. It is basically the cost of getting cash up front. Why does the early portion of a mortgage have more interest? At the start of a loan, interest is calculated using the enormous initial balance you owe, which naturally takes up the bulk of your monthly payment. What happens when you make extra loan payments? Sending extra cash directly toward your loan's principal cuts down the total balance much faster. That means you will end up paying way less interest overall and finish your payments way ahead of schedule. Is it better to pay debt or invest? Deciding whether to tackle debt or invest first usually comes down to comparing your loan's interest rate with potential market returns. If your debt carries a really high rate, clearing it out guarantees an immediate savings. But if your rate is super low, putting that cash into investments might help your wealth grow faster. What is a debt-free lifestyle? Living debt-free means you do not owe any money to lenders. So every dollar you earn goes straight into your own savings and goals, instead of covering monthly loan bills. How can someone become debt-free faster? Speeding up your debt payoff is all about throwing extra money straight at that starting balance whenever you can. Making bi-weekly payments instead of monthly ones also sneaks in an extra full payment each year, which crushes the remaining total way quicker. How does debt affect mental stress? Carrying heavy debt often causes constant anxiety and worry. Why do people get trapped in minimum payments? Minimum payments mostly just cover the mounting interest charges rather than shrinking what you actually owe, making the debt cycle drag on for years. That is why chipping away at the core balance is so important to finally break free. What is predatory lending? Predatory lending involves shady companies using deceptive tactics to trap people in loans with super high fees and unfair terms. It is definitely something we want to watch out for. What is a payday loan? A payday loan is a tiny, short-term loan meant to bridge the gap until your next paycheck. But they usually come with extremely high fees and interest rates that can trap you in a tough cycle of debt. Why are payday loans expensive? Payday loans carry massive fees and steep interest rates because lenders take on extra risk by offering quick cash without checking your credit, which unfortunately traps many borrowers in a cycle of debt. What is an installment payday loan? An installment payday loan is a short-term borrowing option that lets you repay the borrowed amount in several smaller chunks over a few months instead of all at once, though it still usually comes with very high interest rates and steep fees. What is a buy now pay later service? A buy now pay later service lets you grab your items immediately and split the total cost into smaller, scheduled installments, usually without any upfront interest if paid on time. Are buy now pay later plans risky? Buy now pay later plans can definitely lead to overspending, since breaking purchases into smaller chunks makes them feel much cheaper than they actually are. If you miss a payment deadline, those steep late fees can sneak up on you fast. How does buy now pay later affect credit? Using those deferred payment services can impact your credit score in a couple of ways, since some providers report your payment history to credit bureaus, while others might run a hard inquiry when you first sign up. What is a consignor? A consignor is someone who agrees to share the legal responsibility of a loan, meaning they promise to pay it back if the primary borrower falls behind. What risks does a consignor take?